and up and running. So next on our agenda is performance compensation. So we're going to,
Mr. Chairman, I
up?
believe the first thing up, if you want to follow the original agenda, would be to talk about 181 as part of the
okay,
return on
all right,
investment.
let's do that.
So your preference? Okay. That will be, I think a more lengthy discussion, but if you want to handle that first. And I can discuss that first for the committee. The committee knows that we have already considered that bill for the first time during the last meeting. The bill itself has not changed, but the committee did ask for several amendments on that bill. Just to remind you what the bill is about, this is 23 LSO 181, and it's in your packet. It's version 5 or 0.5. The bill basically does two things, and it's fairly simple. It, according to the Treasurer's Office's recommendations, the reserve accounts and their permanent fund counterparts can be better invested for a historically higher return if they contain between 5 and 7% of their annual spending obligations. And so what this bill does is it changes the tip amounts, and that is the amount at which the reserve accounts can grow before the amounts tip back to the corpus, so that the reserve accounts can maintain 7 times their annual spending obligations. And then the second part of the bill provides transfers from the LSRA into each of the reserve accounts to at least get them up to the 5 times number. So in other words, it sets those reserve accounts up to maintain 7 times balances over time when they can build to be that big, but for now it funds them to 5 times their annual spending amount. LSO has adjusted the numbers a bit, and that's one of the amendments that you'll see to be more accurate with the Craig estimates, to get exact numbers that need to be used to fund those. And there is also, the amendment provides the percentages at the beginning of the bill. One of those percentages changes as well to accommodate our calculations. So let me quickly discuss the amendments that were requested by the committee. Those are also contained in your packet of materials right behind the bill itself. There are a couple of other blue dividers where you can see the amendments. The first one, there's 3 of them. The first one is your packet is one on legislative findings. This would simply add to the bill the reasoning behind the bill. I believe to summarize what the committee's hope was is that with this committee and this legislature would then express through these findings the importance of maintaining the higher balances in the funds. The second amendment in your packet would be the packet on the inviolate nature of the reserve accounts. This is the concept that these reserve accounts, unlike their permanent fund counterparts, are not constitutionally protected. So that means that, theoretically, a subsequent legislature could come in and take part of the funding and therefore bring them below these values that allow more, better investment strategies. So that is an attempt to change the inviolate nature of the accounts, to make them, at least to convince subsequent legislatures not to do anything with those. And then the final amendment is one on the title and transfer amounts. And that's what I had mentioned to you before. That's kind of a cleanup amendment. That's just LSOs finalizing the numbers that need to be in there for the SRA transfers. And then it makes just a conforming amendment to the title. So fairly straightforward on that one. Mr. Chairman, I'm happy to go through the amendments if that's, or I don't know how you would like to proceed.
So what's the committee's pleasure? I wouldn't mind a quick synopsis from the Treasurer's Office, and particularly from Patrick, kind of re-explaining exactly why we're doing this and the benefits that we reap from it. Because this is an educational process that we have to basically know on the back of our hand every time we talk to it, and to support what we're doing and why we're doing it. So I'd like to start there, and then let's jump right to the amendments from there, unless anyone else has any questions on the bill itself. Welcome. Mr. Fleming,
Mr. Chairman.
go ahead.
So, Mr. Chairman, just for clarification, just talking about the big picture of what we were trying to do to give the
Right.
committee as a whole as
Yeah,
opposed
and
to.
what, what I mean, if you were going to sell this to the legislature, what would you tell them? Why are we doing it?
Okay, thank you, Mr. Chairman. So number one, the focus that we're trying to achieve here is to maximize returns and simplify the investment process. And, it seems very simple, but to be able to do that, we need to change a couple things legislatively that would allow us to do those, to achieve those objectives. So if you go back over time, 20 years ago, we had 5 different funds. Now we have 15 different funds, and we do it backwards from the majority of what other people would do. Most of the funds out there would take a large asset allocation, an asset allocation of all the funds, and each fund would then fit within that. So for instance, CalPERS might have 15,000 accounts. They have one big fund that they manage under, similar to WRS. And what Sam does, sitting behind me, is that they have one fund, but they have numerous recipients of those funds. We did it backwards. We would start a fund and say, oh, Pool A, here's Pool A, let's do that. And we would have an asset allocation for that. So what we're trying to do is simplify that. Another issue that we have is what we have is called income focused. Because of our spending policies, Common School, for instance, has that 5% mandatory spend. So years ago, when the portfolio was primarily comprised of fixed income securities, i.e. bonds, and had a higher return, it wasn't an issue because, years and years ago, 30-year treasuries were at 15.5% and cash was at 20. So we never had that issue. Now, as we talked about earlier, what I talked about is the definition of earnings is our issue. And so that is interest income, dividends, and realized capital gains. So with that, as I said this morning, we could have 100% return. And yet if the securities were in equity or what have you, you'd only get a 1% or 1.5% current dividend rate, and we would not be able to achieve those spending policies, even with a 100% return. So what we're talking about is saying, how can we simplify the process, getting back to that, and then enable all of these different funds to achieve that same type of return? So let's go back to Common School. So years ago, because of that 5% spend, we had what was called an income focus. And so with that, if you look at the differentiation between what Common School's return was and the Permanent Mineral Trust Fund, which is basically that modified endowment structure, which we've talked about numerous times, over the last 5 years, we just said, okay, if we're going to use an analysis, let's just take 5 years, we could take any time, and said, well, what did Common School earn with its income focus, and what did the PMTF earn with its total rate of return focus? And that amount equaled $313 million difference. So that was the opportunity lost by not being able to do that. Well, simple solution, why can't we do that? Well, the reason being is if we didn't have that mandatory 5% spend, then we wouldn't be able to fulfill the income that is required for Common School. So what we do with the reserve accounts, which are only, year and a half or 2 years, Polly can give you much more information on that. She's very good at going through all the numbers. We don't have the reserve accounts to go through the amount of money in the reserve account to fulfill that 5% spend in periods of very low returns or down year. And so what we've done at that is saying, okay, well, we're going to have the income focus, but also the reserve accounts would be housed in the state agency pool. And all of you know that the state agency pool is just a cash surrogate. It's just going to earn short-term funding. Well, what would we have earned if we would have been able to put the reserve accounts into a higher yielding total rate of return-esque type of investment? And we just took Common School and PMTF's reserve accounts, and that was another 140 million. So basically, we're talking about $370 million in these various funds. 313 is the largest one in Common School, but the other permanent funds would equal 370 if we had that same type of asset allocation, and another 140 million in the reserve accounts for a total of, 510 approximately. So over the last 5 years, we've left approximately $100 million on an opportunity loss by not having these types of investments. The other side of it is for all of you, which we talked about a little bit before, if you could have that runway that you know that you have for the next 5 odd years, that money set aside to be able to do this, it would be, I think, much easier for you to know instead of every 2 years how much you have to spend, but you're going to have a 5-year runway, assuming that we could increase our reserve accounts to at least a 5-year spend, and potentially up to a 7 would even be better. And so it's not only for, any of the Pool A accounts, but it's for PMTF, it's for Common School, Higher Ed, Hathaway, go down the list, all of them would then know how much money that we would have. So the idea would be to increase the reserve accounts to at least a 5-year spend. To take all of those various funds that we talked about and where we can, put them into a total rate of return strategy. Then take those reserve accounts and put those into a total rate of return type of strategy. With all of that combined, we know historically that a total rate of return strategy will outperform cash. That's, can that happen in the future? I'm highly confident that it will on a long-term basis. And with that, that would then give all of you a better runway to know how much time you have to spend all of this, all the projects that you have, that even down years, that we'd have at least a 5-year reserve account to fulfill those underperforming years if we had a bad year. So the committee had asked, well, let's do a simulation. RVK did a Monte Carlo simulation to say, okay, what if things were really, really bad? How much time, how much do we need to be able to do this? And the thought was that we have to have at least 5 years, if not 7, to be able to weather any really negative periods of time. So to reiterate, we need to change our asset allocation, which we can do easily internally, but before we can do that, you have to have a reserve account that would make sure that you have at least 5 to 7 years, because right now it's just in cash, because if you have bad years, it's gone. If you lose 50% in the total fund and 50% in your reserve accounts, you can't fulfill that. So we have to do that and have that ability to switch those different funds. So what we had talked with the subcommittee and to numerous members is being able to increase those reserve accounts. That would enable us to change those accounts, simplify our accounting process, be able to have quarterly distributions instead of monthly, just numerous different things that would make our life and Katie's life and Don's life and Kurt's life, the treasurer's life, so much simpler. And many of these issues that we'd have would have gone away if we were able to do that. So, Mr. Chairman, in general, that's kind of the big picture of what we're trying to do.
Mr. Chairman, go ahead.
So Patrick, just for clarification, so under this scenario, if we do this and we fund these at 5X, you could immediately go in, or I say you, but the SLIB through authorization and then asset allocation could change those asset allocations to reflect, so let's use Common School, to reflect what we do with the PMPM Permanent Mineral Trust Fund right now. So the asset allocation would change on the existing account. But you're also saying with those reserve accounts, would have a similar asset allocation, or would they have a little bit different short-term horizon on the reserve accounts, or would you anticipate those to be identical?
Mr. Chairman, Senator Hicks, that's a very good question, because that's the part that we looked at, and that was what was really instrumental in RVK's study to say, okay, what are the funds that potentially would have a problem with that. And one of them was the reserve accounts. And so when we looked at that scenario, that Monte Carlo simulation, and what we did is we stressed it to where you had really, really bad returns for 3 years in a row. And so the one issue that we'd have in a reserve account is that illiquidity component. You can't have private equity into a fund that you need to spend. So as you mentioned, that little tweak, you'd have to tweak the reserve accounts to be into its more liquid alternative, i.e. public equity. Pool A. Pool A is the same way. You look at it in what we talked about before, if those funds actually needed the money to spend for whatever purposes, firefighters, big building or whatever, you don't want it to have into a 10 to 13 year duration asset. LISRA, that's an easy one. There's no way LISRA could be in a total rate of return strategy. So those were the big three funds that we'd say, okay, well, we can still have this, but instead of private equity, you'd have public equity. Instead of private credit, you'd have public credit. So there's different ways that we would then be able to take our asset allocations to really mimic that, but you still have a very high rate of return.
So, Mr. Chairman, so another follow-up question, Patrick, is the concept that we're going to take all these, gets back to the 15 accounts. We got all these accounts and all these transactions. So all these reserve accounts would have what I would say a pooled asset allocation. So in other words, the asset allocation for the common school, does it look exactly like the permanent mineral trust fund and the Hathaway reserve account? Do all those reserve accounts then are really one account, but we have a pooled asset allocation? So how do you envision that working?
Mr. Chairman, Senator, that would be exactly how it would be, is that you would have a very similar asset allocation. I'll leave it up to Katie to go through. Is it make it better to have a pooled asset allocation, or should you have the PMTF reserve, the Common School Reserve, Hathaway Higher Ed Reserve, or would it be better to be pooled? That is, kind of at the edge. That's not important to do it, but the asset allocation needs to be more liquid. That's the key, than a total rate of return that has illiquid. Now, what would there be a slight income differential between that? Yes, because we know that private markets on a whole outperform public markets. And if you look at it, it's called an illiquidity premium. But in general, you might say, some people say it's 1% to 2% or whatever. I think it's more 3, 4 to 5% differential. But of that one portion, you would have a slightly different, lower return in a public market than a private, but it would be not significant enough
So,
to
Mr.
make a
Chairman,
difference.
I don't know if that answered my question. I think maybe my question. So we set up all these reserve accounts, common school, Hathaway, higher education, permanent. Do they all have in the reserve accounts now? We're just talking about the reserve accounts. Do they all have the same identical asset allocation for each one of those reserve accounts or not?
Mr. Chairman, Senator, I would say yes. But until we actually go through the asset allocation, we'd have to look at it and see if there's anything different. But the theory in general, they would all be the same.
Good, because that's what I've tried to explain to people. It's more
Yes.
about a pooled asset allocation. It's an asset allocation pool as much as it is. So, I mean, if they all have the same asset allocation, you're just dealing with one account, and then each individual entity owns a percentage of that account.
Mr. Chairman, Senator, that is correct.
Yeah, all right, thank you.
Go ahead.
Thank you, Mr. Chair. So following up on that, we're talking 4 or 5 reserve accounts, pooling them. But then there's one other reserve account we already have that's not being talked about, which is the LISRA, which, I mean, I'm having a hard time thinking why we just don't roll all the reserve accounts into one account, call it whatever you want. The amount that would have to be liquid percentage-wise would be decreasing. Is that correct?
Mr. Chairman, Representative Schwartz, the difference on the reserve account LSRA and the reserve accounts that we were referring to before would be the return. The LISRA return is not made to maximize the return. We have the short term, the 500 million in the short, we have the core, and then we have the long. That is not, that asset allocation mix, thank you, would be different and would not historically return the same as the total rate of return fund.
Yeah, how is that, what's the percentages and what's the dollars on the 500 in the LISRA?
So if you go as the Craig projection or whatever, we're projected to have what, 2.92 in 2024, I believe. So how we do it right now is the first 500 million is a short-term reserve. That's just a very, a 2-year duration, short-term liquid. We need it in 2 days, you got it. The next amount, what we do is then we have split between the long-term reserve and core bonds, which is basically the Bloomberg Barclay aggregate. And those two are then split depending upon the liquidity needs, et cetera. So at the time, if we would have dropped down, we got down to about 1.3, 1.2 in the LISRA with some other things. We're saying, okay, we're getting down to where we need more core bonds for liquidity's sake instead of some of the longer term reserve. At 2.92, do we really need, $2.4 billion split between these two funds? And this is again where we go through that asset allocation in the spring, which we do every year, and we'll look at it and say, does this optimally make sense for that allocation in that amount?
Go ahead.
Thank you, Mr. Chair. Yeah, so but if we, let's just say hypothetically, we just had the one reserve account, maintain the 3 tranches that the LSRA has, we could adjust the amounts based on the fact that the demands would be differently, but it still seems to me ultimately we could improve our return rate overall. Is that incorrect? I mean,
Mr. Chairman, Representative, absolutely, it would improve the return rate, just as we said before, when we're putting in a cash, going into anything above that cash, historically, long-term will improve it. But what we're saying is we're really trying to maximize it. So could we do that? Yes, but it wouldn't still be the same need. If you really think of it, the LISRA is almost like an income focus fund. So do you really want all of those into an income liquid focus fund? No, because if in fact we are looking at this reserve for 5 to 7 years, you have that ability to have something that's a little bit less liquid than theoretically we need in 5 business days in a problem. So the vast majority, that 500 million, 5 days. The next core bond, 2 days, short term. Longer one, 3 days. After that, up to a month, I would say, is probably, that's the liquidity of those 3 buckets. So in that instance, what you're referring to, yes, we could do the LISRA as a total thing, but you would not have, if you ran, I don't have those numbers, but you can look, I can pull this up and look at the LISRA's return versus the PMTF, and I'll show you the difference, but it will not be anywhere near as high as the PMTF.
So I won't go down this rabbit hole any farther, but it would appear to me that ultimately if we put everything into one reserve account and adjusted the asset allocations to the tranches, that third tranche, whatever, could basically almost be a total return because there's enough in the lower 2 tranches to cover a couple years, 3 years of bad returns. But I'll leave it.
Representative, Mr. Chairman, Representative, you're spot on, and that's basically called unitization. And unitization, when as a mutual fund or what have you, when you're able to unitize the returns, then you're able to do that. We have spent numerous days, weeks, months, years. In 2015, when I came here, I tried to unitize this. It was not possible at that time. Katie and Dawn and everyone, the treasurer, were working on that, but it's not possible from our accounting standpoints, from our Broadridge who's doing it, and also from our custodian. They said we cannot implement a unitized accounting system yet. So that's the next goal, which they said would be within a couple years. But you're spot on how you're thinking about it, but we can't just take a percentage, a unit of each one of these funds and create this. And that's what the majority of other people do.
I think that helps. It's a good refresher. Thank you, Patrick. Okay. Let's go to amendment number 1. You want to walk us through it?
Sure. Mr. Chairman, is there any order in which you'd like to prefer to consider the amendments?
Well, let's
Mr. Chairman,
go ahead.
can we go to the bill? Because there's some red
Yeah.
line additions in the bill that I've got some questions on before
Oh,
we
absolutely.
get to the amendments. And so, let's see. Ian, if you can go to page 8 and then line 5. And so this is the only place that I've seen where we struck out the percentage in the spending policy, and we've changed that from 4.5 to 7. And then there's an amendment that then raised, so you can address this all at one time. What's going on there that we have to go in there and change these percentages?
Very good. And Mr. Chairman, if there's specific questions, I can defer to Polly because she's the one who calculated the actual numbers. But the idea here, and this one's a little different because the spending policy is different for Hathaway than it is the others. You know, the others have a 5% spending policy, for example, but Hathaway says the spending policy is the amount you need to cover scholarships. So that's why there's a dollar figure in here and there's a percentage. But these percentages, and this isn't in fact the only place, like you'll turn to 2 pages before on page 6, for example, we're changing that from 150 to 210%. All 4 reserve accounts do get a change to the percentages.
I understand the percentages
The tip,
from,
okay.
going from a 210%. That all makes sense. That's to get to the 5X,
Yeah.
right? So when we get down to this point, we do the $44 million, that should have got us to the 5X.
Mr. Chairman, actually these, and Senator Hicks, these actually for the tip amounts go to 7X. So the funding is at
Okay,
5X,
so-
these are 7, right?
But this says in an amount equal to 4.5%, right? That's the current monies within the reserve account and excess greater. So that's the tip, right?
Mhm.
But now we've changed it, so we're just changing the tip, that it wouldn't tip until it's at 7%. Is that correct?
Mr. Chairman, yes, and but it's for the same purpose. That's why none of these, well, there's a couple reasons that the percentages don't match up perfectly with what you think. For example, a simple 150%, you'd think you just raise that to 500 to get to where you'd want to be. It's a simpler number than on this Hathaway scholarship. But the theory is correct, and the calculations our folks have done. It is exactly for that purpose, to get that fund to what you need to cover the spending obligations for 7 years. And so that's where that number's, and Polly, I invite you to give a little more information about where you come up with the exact 7%.
Yeah, and Polly, before you answer that, so what projections did you use on Hathaway for inflation? You know, I mean, is this an upward amount that you've calculated in there based on current usage and projections? How did you come up with that?
Mr. Chairman and Senator Hicks, I'd be happy to talk about that. And I'll be referencing this colorful chart, which is in Appendix C of your spending policy document, which is online document 902. It's the very last page of your paper booklets. Yes, we knew when we met in September that there would be some changes after October Craig completed. So the Hathaway is a little bit different than the other ones in that there's really no spending policy that's a percent of the corpus. Like the other ones, it's the amount of scholarships that's needed. So LSO we did project fiscal year 23 scholarships. The way we did that was we took a 5-year average, the past 5 years increased by 2%, plus we included $267,000 for the annual amount that's appropriated from the reserve account for the Hathaway unit at the Department of Education. And this is new. This is something that hadn't been there before. So that spending policy amount for fiscal year 23 was higher than what was used in the preliminary numbers. And that's why the percentage went up to 8% from 7%.
And that was based on utilization, projected utilization.
Yes, yes. And as I said, it's the 5-year average of scholarship amount increased by 2%, plus the appropriation for the administrative cost of the Hathaway unit at the Department of Education.
All right, thank you.
Go
So,
ahead.
Mr. Chair, Polly, just following up on that though, but the appropriation has not ever exceeded the revenues generated. So we are still growing the corpus.
Mr. Chairman and Representative Schwartz, I'm not sure about ever, but yes, this year, the investment earnings were greater than the scholarships, and there was actually a tip into the corpus for the Hathaway this in fiscal year '22.
Right. And when I say ever, I mean my terms in the legislature. Anything that happened before then is kind of irrelevant.
So what I'm curious about it is because, you know, what we talk about with the Hathaway is increasing because it's, you know, it's growing. And it provides the opportunity to increase the amount of the scholarships. And so how does that then would affect, every time we do that, we'd have to add to the reserve funds as well. Is that fair?
Mr. Chairman, currently the reserve account is at the maximum, which is the greater of, statutorily right now, it's the greater of 12 million or 4.5% of the corpus. And it equates out in fiscal year '22 to be a little over 27 million. And so it's at the maximum. This year, the investment earnings exceeded the scholarships. And so there is a little room in there.
So it will tip.
There has been a corpus tip for fiscal year '22, 7.4 million tipped into the corpus. But the reserve's at the maximum, and then this bill would increase the maximum if it were left as it is.
Next question? Any other questions on that?
Mr. Chairman.
Go ahead.
Yeah, so let's talk about the tips. And so my understanding is this is we do the 5 or let's say the 7X and it's in there. So we've got our spending policy. We generate enough revenue off of this to cover that spending policy. Where does the tip kick in that tips back to the corpus? Is it just when we hit that amount and there's sufficient money for the spending policy? But where is that structurally in the bill that outlines that that's going to happen?
Mr. Chairman and Senator Hicks, that is, would work really the same way that it's working currently, just at a different percentage. So if you go to page 4 of the bill, the first on pages, lines 2 and 3, the language that's struck out, the 150%, that's the current maximum on the reserve account. And it would go to the 245%. And I do just want to clarify that the 7 times amount is less an assumed 2% dividend and interest income. So that, in the case of the PMTF, that leaves you with an effective spending policy of 1.75%. So we would take that 245% every year and we would multiply it times the 5-year average corpus, get a dollar amount, and that's where the maximum is every year. So every year it does depend on the 5-year moving average of the corpus.
Okay, thank you.
Please.
So to say it another way, I'm going to say this and correct me. So the 245 is a 7X on the permanent trust fund at the 3.75% guarantee, which is really only 1.75 because 2% is dividend interest. Not to get too weird on that, but the 245 is the 7X. Let me say it simple.
Mr. Chairman, that's exactly right.
Yeah, it
What you
won't
said
tip
is
until
exactly right.
245.
Yes.
With all those different factors, the 2% annual return that we can count on, exactly what you said, that's
Yeah.
right.
Mr. Chair,
Go ahead.
quick question for Polly. On the very colorful chart, Appendix C, you have a note, amounts highlighted in orange are as in 23 LSO 0181, and I don't have any orange on my printout. I've got yellow, red, purple, green, and blue.
Yeah. Mr. Chairman and Senator Kinski, it's every one of these tables is one fund, and it's on the PMTF, you'll see the $274,700,000 highlighted in, I call it orange, maybe it could also be tan. That's going to be in the bill if the amendment as is were adopted. And then in the next column over, the 245%, that's in the bill. So that's the color that's orange. Maybe it could also be called tan.
Okay, and Mr. Chairman, so that column is 5X. The 274 is 5X.
And yes, Mr. Chairman, so the way the bill is structured, the increases to the reserve accounts are designed to be at the 5 times level, and then the maximum
7.
percentage is designed to be at the 7 times
Okay,
level.
thank you.
So that will grow to get there. We didn't want to cough up that much cash. Go ahead.
Thank you, Mr. Chairman. So Polly, is that the same on all of them, that the orange is in the bill?
Mr. Chairman and Representative Larson, yes, those are the numbers that are in the bill and as amended.
So, Mr. Chairman, so I go to page 8 on the Hathaway, and I should be able to find 4.6 million.
Mr. Chairman, sorry, except for this assumes we have an amendment that brings them to those accurate numbers. So not as the bill draft in front of you in that version, it would need the updated numbers for that.
I couldn't track it. Thank you, Mr. Chairman.
Are we ready for any other amendments or anything on the bill? Yeah, go ahead.
So Polly, now I'm confused because I thought the number for the permanent mineral trust fund reserve I wrote down was 334, but in this chart, it's 274. Where did I go wrong?
Mr. Chairman and Representative Schwartz, you did not go wrong. That 334 was the preliminary number before Craig. After Craig, it goes to 274.7. We ended up having money above the investment earnings, above the spending policy, so there was an increase in that reserve account, so
Just like
less.
that, we made 50 million. Boom.
Thank you.
Where's my 10%?
Go ahead.
Thank you, Mr. Chairman. I think this question is for Patrick, if he'd be willing to step up to this. So this bill, it raises the cutoff to 7%, or up to the 7% times, but it funds it at 5%. And my question is that like a cliff number, that 5%, or is there value in funding it in these reserve accounts at any level that we would raise the amounts?
Mr. Chairman, Representative Obermueller, this 5% is thought generally amongst the consultant statisticians about what is needed. And so that's why we went back and actually did that Monte Carlo simulation to say how bad in every year would it have to be. So in that instance, we feel pretty confident with, high confidence interval that if it was in a 3 year, the 5 would work. So that's kind of the minimum that you'd want. Maximum, some people have, 15, 18, 19 times spend in their reserve accounts. So if we had this constitutional amendment, you don't even care what your reserve accounts are. You just want to do your return. But the minimum is typically 5, and a general maximum would be 9. And so if you look at it, if we could go from 5 to fund that to get us going and gradually increase it up towards a 7, that's kind of the mid-range of where you'd want to be. But with all of those 5,000 iterations or whatever they did, they felt that the 5 would be sufficient for the time being. Right now, optimally, you want to go to 7.
Okay. So the numbers that we have to fund that are in this bill are kind of the baseline. That's where we start.
Yes, sir.
All right, thank you.
Mr. Chairman, it brings up the whole discussion as to whether we want to just fund 7 at this point in time, knowing what the LSR look like.
Well, go ahead.
I think, Senator, same kind of thought, you know, and appropriations has moved now to these 6-year profiles. And my question, Don Rich is not here, but with a 5X is, because we have this imaginary cliff we have built in when the investment revenue goes away, because we only count dividends and interest. So that 5X, does that just take us through 5 years of JC Craig forecasts? Because we just got the new 6-year deal, right? I didn't see any fall off on that. So that was one of my questions. Is it better to fund it at 6X to take away the imaginary deficit we have?
Mr. Chairman, I would just say you
Don's
could,
listening,
you could
so-
tell me what, there's a
Well,
guy over in Russia, what he does will help project
Well,
that 6-year thing.
no, I hear you, Mr. Chairman, but I mean, would it make sense to do that? It's kind of what the senator's saying. I mean, I just want to kind of, so we line all these ducks in a row.
Well, Mr. Chairman, I think the question there is the bill drafts themselves, amending the statutory provisions, don't depend on our future economic forecasts at all, right? I mean, that's not where these numbers have come from at all. But the question then, I mean, what happens if we funded at a 5 times level today in circumstances where we expected to start invading those reserve accounts to meet their demands in the next year and the following year? Then you do have a problem because we've immediately reached that imaginary cliff. Now, if we're in the opposite situation, we expect to continue to build those and have returns that will adequately fund them, then that's not an issue. But so the bill itself is not dependent on our forecasts. The numbers we've used are not dependent on the forecasts.
Mr. Chairman, and I understand that, and I'm just looking, I pulled up these revenue expenditures that we just got from LSO here this week, and I'm just looking out to the 27-28 biennium. And, you know, that's what because we've always had this cliff where, boom, investment income, which is now a substantial part of our revenue in our state, been so blessed that just so it matches either that, I just want to make sure we can match that forecast with our investment return forecast, basically. Does that make sense? I hope I'm making a little sense on that. If we have a 5-year guarantee and we have a 6-year forecast, it falls off the cliff in the 6th year. That's all
Go ahead. Sure.
Thank you, Mr. Chairman. Patrick, another question. So the SIPA guarantee, now has that piece been calculated into the 5 times and the 7 times as these numbers are constituted, that they take that hypothetical into account that could possibly happen? Or do we need to be adding that SIPA guarantee amount on top of the 5% dollars that are calculated here?
Mr. Chairman, Representative, no, that was calculated into the total number. And that's why you'll see the difference in when the tip goes between the common school and the PMTF. Those numbers are different because of the 375 versus 5 with a base floor of 2% that we were thinking of. And just while I'm here, just another comment. When we were looking at the difference between the 5 to the 7, 7 would be great, 9 would be, wonderful, whatever. And at the time, we were just looking at it and saying, just back of the envelope numbers, it was around 750 million that we were looking at. And so we were saying, okay, what's the probability of getting this passed at a 5 times spend versus a 7? And that's why we said, okay, let's focus on the 5. Would it fulfill it? But in that presentation that Josh did, we'd have both of the 5 and the 7 in those simulations. And I'm not sure if that was distributed to the entire committee, but you'll have those numbers and you can see what happens in the simulation between the 5 and the 7. But the 5 did fulfill it, but it would be great to get us 5, 7, whatever you feel like you can appropriate. But at the time, I think it was a subcommittee was said that probability of getting this through with that amount of money would be better to shoot for the 5 first and do the tips towards the 7. And that was the reason for that.
Thank you, Patrick.
Don't go away, Patrick. Please. I mean, I can't command it, but.
Not today, not tomorrow.
Yeah. No, and I'll be honest right now, I thought I knew what was going on, and now I'm actually more confused than I was when I got here this morning. But just looking at the PMTF, and that one's already invested as total return, the corpus. We are not, it's not like the common school where we feel that need to have liquidity for cash. So explain to me then what the value is in increasing the reserve account above what it is at the moment, which we have considered to be adequate. And how much money will that generate, and what will be the essentially, it's hard to calculate, opportunity cost of putting more money into an inviolate reserve because we could use it for capital construction, say.
Mr. Chairman, Representative, you're spot on. So when we were looking at this, we're talking about investing in a total rate of return fund. Well, the PMTF is already total rate of return fund, so why do you need to increase that? So if you remember back when I was talking about the $370 million that was saved by combining all of the major Pool A, Higher Ed, Hathaway, PMTF, Common School, all of those main accounts, that equaled $370 million. And then remember I said there was an additional $140 million by taking the reserve accounts, which are in the state agency pool, earning cash, and investing those into a total rate of return strategy. So those were the two funds, were Common School and the PMTF. So again, we didn't have the up-to-date numbers that Polly has right now, but if you took the PMTF reserve account of that $140 million, what I'm referring to, in the reserve accounts, investing into a total rate of return strategy, that $140 million was comprised of two different components, Common School, PMTF. The PMTF's amount in additional income was 90 of that 140, and Common School was 50. So by not funding the PMTF, you could easily do that because the strategy is already there. It doesn't impact us. The difference is the opportunity loss of not investing the reserve account of the PMTF into a higher yielding asset. And over the last 5 years, that equated to approximately $91 million. 5 years.
16 million a year.
That is correct.
Chairman?
Go ahead.
Yeah, so I think I've kind of coming full circle on this whole thing. 5X is pretty amazing. I mean, really, I think it's amazing. I mean, we can do this 639. It's pretty amazing. And I think come back in a year and see what it looks like and want to add to it. Yeah, it's amazing. Amazing opportunity we have in front of us.
Okay. Other questions for Patrick? All right.
Mr. Chairman, just one other comment. The committee had asked that we would go out and talk to all of the participants to make sure that everyone was on board and so forth. So we reached out, obviously, to Pool A and some of the other ones. The SLIB was one that we talked about, and what was the view there. And the SLIB's response was, in general, they would be in favor of this. And the governor had said, is there anything we can do for Common School to increase it? So there was that kind of unanimous agreement that, in principle, it made a lot of sense. You increase your returns, you reduce your complexity. Of course, we'd do that if, in fact, you could make that. The one thing that I did want to reiterate was the governor's comment, and I'm paraphrasing, that he was saying that the one concern that he had was if you have this money coming into the reserve account and it's not protected, and obviously this amendment protects it in a certain way, but that would preclude future legislators or legislation to come back in and raid the reserve account, because that's what's happened in other states. Alaska has a famous one. They had 18 billion or whatever it was, and they took 15 in 1 year to spend. And that was his one concern, that great, if we can do this, that's wonderful, but you have to protect those reserve accounts from future legislation to be able to raid them. So I just wanted to comment on what other members have commented.
So, having raised 6 children, when they say they kind of agreed, what does it mean when you say the SLIB kind of agreed?
Sort of.
Sort of agreed.
That's a little more than kind of.
Give me a little more confidence here.
Mr. Chairman, Representative, because they didn't have a bill in front of them, so we were talking about conceptually, would this make sense? And they said, yeah, conceptually, as I said, increase our returns, reduce complexity, of course, but always the devil's in the detail. And so that was one thing where the governor went a further step to say, yes, conceptually, this would be wonderful, but if you have it, so these reserve accounts, if we're just putting money in the reserve accounts and then later on, you're going to yank them out, that would be not only problematic from his perspective, but from our perspective, it would be a big deal because we're taking all of these securities and putting them into a longer duration assets, the bid offer spread to then reduce it. So if you did come in and you just spend it and all of a sudden we're back down to a year and a half, we would then have to go back to the previous way we were doing it. So if those reserve accounts are not protected, that would be problematic from an investment standpoint because of the assets that we are investing in are less liquid. They're still liquid enough, but it would still be more bid offer spreads, et cetera, to then reverse and go back to where we are right now.
So I think one of the first questions that people are going to ask is, well, why don't we just put all this into the permanent funds? And then it's going to be invested in the long term, and we'll still have our reserve accounts where they are. So what's your response to that?
Mr. Chairman, we'd have a higher return per se because it's there. But again, we would not be able to fulfill that spending requirement in down years, 3 bad years, because we'd still only have 1.5 year spend. So that key to be able to move into a more risky investment is to know that we have the backstop to fulfill the 5% spend in common school and the 375 in the PMTF. We already have it in the PMTF. We know, we have that return. We feel okay with it. But if you didn't increase the money into the PMTF, it wouldn't impact anything else other than the return that you're receiving in that reserve account. And in bad times or whatever, the 375 could be problematic and you would have to do something.
Okay, further questions? Well, any public comment on the bill? Let's do that first. When we work the bill. Okay, any public comment? Seeing none, we'll close public comment. That was a tough one. Okay, bill's been moved and seconded.
Mr. Chairman, can you tell me who moved the bill? I didn't. Harshman? Okay, thank you.
Amendments. So let's go to the first one, which is the easy one.
Yeah, Mr. Chairman, you might want to, I think the easiest probably one is the cleanup. It's the last one in your packet. It says proposed amendment title transfer amounts. The reason that might be easiest to go through first is because what we've been talking about this entire time.
Wait a minute, it's called
just-
what?
Title/transfer
Okay, gotcha.
amounts.
Actually, I thought inserting section 3 and section 4 was the easiest.
Starts with page 1, line 4. And Mr. Chairman, this amendment starts on page 1, line 4 with a simple change to the title of the bill. It initially said providing appropriations, which might be fine, but in fact, they're transfers from the LSA, so it simply changes that language to providing for transfers of funds to specific reserve accounts, just to clean up. And then the remainder of the amendments are all exactly what Polly had described. They're simply changes to reflect the current CRAG. The amounts have been changed to actually represent what in the current conditions as we know them is a 5 times spending funding of those individual specific reserve accounts. And then as we also already discussed with Senator Hicks, that page 8 line 4 and page 8 line 5 amendments are the specific portions of the Hathaway to adjust that spending policy to allow the 7 times tip. So these are technical amendments. They are just simply meant to update the numbers to accurately reflect the numbers that are consistent with the new CRAG report.
Mr. Chairman, I'd move the amendment.
Moved and seconded. Any discussion? Go ahead.
Mr. Chairman, little discussion on this and visit with this, is these are based on the October CRAG that we got, correct, Polly?
Mr. Chairman and Senator Hicks, yes. And going back to the colorful chart, and I have extras of that if anybody needs it, the available balances are all with Craig for the PMTF and the Common School. The Excellence in Higher Ed and the Hathaway are not profiled with Craig, but those are the updated available balances.
So, Mr. Chairman, where I'm going with this is we're going to get an update in January on the January Craig and discussing this with staff and with Ian. They're probably not going to change a whole substantial amount, but right now I would say I'm okay with this, but just put a question mark behind each one of those and
Knowing that they'll be addressed again,
what's that?
knowing that they'll be addressed one more time.
Yeah, I think we ought to come back and get this as close to, as to what, just for the sake of the body and the explanation for the one or two mathematicians that we might have on the body that says, how come this doesn't follow? So with that, if we just put that caveat on there to look at that in January to update those, be one of
then,
the
yeah,
last actions that
And
JAC
give us new
take.
numbers and just send us an email with those, what that would look like.
Mr. Chairman, I can certainly do that, and I know that Patrick's very involved with Craig, and I'm not sure that they readjust the projected market value of the corpus for the January Craig, which would be the main impact if you do that. I don't anticipate there's going to be a change because I don't think that they do an update on the looking forward corpus market values, but I've taken that down.
Representative Larson? Okay. Okay, any discussion? All those in favor of amendment, say aye. Aye.
Aye, Perkins, aye.
Welcome, Mr. Ex-President. All those opposed? Okay, that passes unanimously. Next amendment.
Mr. Chairman, if you'd like, we can first talk, I guess, maybe about the legislative findings.
Right, let's go to legislative findings.
So that's another amendment. That's a 2-page amendment if you're looking for, actually 3 pages, front and back and one other page. It starts with page 1, line 4, and then it says legislative findings. This was similar, the next 2 amendments are under the same vein. They're the idea in what's already been discussed, that to the extent we can dissuade future legislatures from invading these accounts, the better off they'll be to provide the benefits for the reasons that we're funding them. The legislative findings are a little bit unusual in bills, but they are sometimes used for exactly this purpose, to try to direct the intent of making the amendments in the first place. So these legislative findings simply, it's fairly descriptive. It goes through it, it describes the establishment of our permanent funds, the establishment of the reserve accounts that serve those permanent funds. Then on the very first page of that amendment, paragraph 4, IV is probably starts into kind of the meat of it, because it talks about the consequences of the short-term investment strategies that have had to be used because the accounts aren't adequately funded for longer-term investing, which is part of, I think, why this bill is here. On to the next page, it actually summarizes the opportunity cost that was estimated by the State Treasurer's Office at $370 million over the last 5 years. Paragraph 6 on that same page then describes that funding these reserve accounts at 5 to 7 times their annual spending obligations is a solution to allow them to be invested in a longer-term strategy. Paragraph 7 and 8, we actually state that the benefit of this investment strategies only last as long as these funds can stay adequately funded. Paragraph 9, IX on that page then describes the fact that the reserve accounts are not constitutionally protected, which is the reason why we need this language in the first place, to try to impart the importance of not invading them later. I'll read the language. It says, consequently, fiscal restraint and a long-term commitment by the Wyoming legislature will be necessary to maintain funding for the reserve accounts of the amounts provided by this act, and at levels that maximize investment returns and provide maximum benefits to the beneficiary of Wyoming's permanent funds. I think that's the crux of these findings. Mr. Chairman, any questions?
So is it fair to say that basically what we anticipate is roughly an overall increase in available dollars of around $70 million a year?
Mr. Chairman, that's right. Per year, you're talking about the avoided opportunity cost of short, yes.
or what we'll gain.
Right, yes, right.
And so, you know, to me, that's one of the keys of this whole thing is that this will pay for itself over time and then some. And it will help substitute for our loss in revenues from a declining minerals funds. And so that's what we're doing.
Mr. Chairman, I only got one question when we talk about in Roman at 9, and it talks about consequently fiscal restraint. And I think in the context, the way this is used in there, the way I would read that is we can't spend the corpus of the reserve account. But as we've been working in cap fin and appropriations, there's a lot of other instruments that the legislature has historically put on these accounts that become a drag on investment, like public purpose investments, guarantees, other obligations. And my question is for staff is there some way we could improve the word fiscal restraint and maybe enumerate some of these other things from a standpoint, it's not just spending the account, it's putting encumbrances on the account or obligations on those accounts. And so maybe bring in that language, fiscal restraint, including but not limiting to spending the principal of the account or other encumbrances or something of that
So,
nature.
well, and to follow up on that, some of the reserve accounts currently provide guarantees, do they not? No? Did they
Mr.
run
Chairman,
out?
I believe they do. There are at least two that Polly and I talked about earlier today that, and if you want to talk about the two that we discussed.
Mr. Chairman and Representative Harshman, the one that you're probably familiar with is that there is a statutory provision to allow the PMTF reserve account to fund the loan loss reserve for the capital construction loans. So there has been, even in fiscal year 22, there was transfer out of the reserve account for that loan loss reserve. And the other one, and this one is new as of the 23-24 biennium, but the Hathaway unit at the Department of Education was funded out of the Hathaway reserve account.
Yeah, I think we need to just put that on the list to have those fixed, or to remove them or find different sources for them.
I mean, Mr. Chairman, I think we've got to do that or we defeated the purpose
Yeah,
right
yeah.
off the bat by,
I second the motion. No, I agree. I know in like 13, on hard times, we did that same thing. That's a good point.
So Ian, you just want to make a note of that and we'll. So that's a conceptual to draft a bill to do that. All those in favor say aye. Those opposed, that motion carries.
And Mr. Chairman, to be clear, then you'd like a bill drafted that removes those excess obligations on any of them on all four of these reserve accounts, correct? Okay.
so Mr. Chairman, do you think that needs to be separate or companion? And the reason I say that, what if one moves and the other one doesn't?
You want to tie it into this bill?
Well, that's what I'm asking. It seems to me like they need to be tied together.
I mean, that's fine.
I think that just provides reassurances to all the parties that that it's all or nothing. You think, well, and I agree with it. It may be confusing. Yeah.
So is there anything that we need to do, if we eliminate those two guarantees, do we need to provide a different backstop or? That's my question.
Mr. Chairman, I don't know for sure. I will need to take a better look at those. I'm sorry, I don't. But I'm happy to do, I mean, for instance, the LSRA, I can amend the bill that way if you'd like. Could always then be amended out in session if you'd want.
Yeah,
but-
if we really don't need to do it,
No.
then, so I think we have to have that discussion.
Yeah.
All of us need to have better understand what we're getting rid of.
Mhm, Right.
So clarification, if I may.
Go ahead.
So that motion said the Hathaway would not continue to fund the administration of the Hathaway, correct? Right, but the reason we changed it to that was because it had been funded by the school foundation program. And it was, the Joint Appropriations Committee felt that was an inappropriate use of school foundation money. So just, that was the source of the change.
But the question on that is do we actually need the guarantee or not?
Right.
And I would have to go back and look whether there was funds drawn out.
We just
for
have to fund it.
Yeah.
You don't have to guarantee it. Yeah. Yeah. So I'll amend the motion to as amended. All those in favor say aye. Aye. Those opposed? That motion carries. Okay, back on the amendment. Any further discussion on question being called? All those in favor say aye.
Aye.
Those opposed? That motion carries. Next amendment.
Mr. Chairman, then the final amendment is related in purpose, and that's the one called inviolate reserve accounts. It starts with page 1, line 4, because it amends the title to adequately. It starts at the very top as page 1, line 4, and I believe it's the second one in your packet. It starts with, and the first one with underlined language is page 3, line 11. This amendment is a bit more complex. At the last meeting, we had a lengthy discussion about how to best protect these reserve accounts, because as we know, the permanent funds are protected by the Constitution as being inviolate and against invasion by the legislature. Reserve accounts, being statutory beasts, are not protected from what the legislature might do. There was this discussion about whether or not it would be appropriate to add a 2/3 voting requirement to require a future legislature to invade these only through a 2/3 vote. I did some research on that and discovered that we don't do that anywhere else in the statutes. Pardon?
So?
So, right, we always do that. And I think there's some good reason for that. And the reason for that is that our Constitution does provide that each legislature has the authority to act. And in fact, it says that the authority to act is on a majority vote of the elected members. And so it is inconsistent then to place a 2/3 voting requirement on any legislature. Our Supreme Court has also declared, without a lot of analysis, there's not a lot of case law, but it has firmly supported the majority of, I guess I shouldn't say the majority of other states, I don't know, but many other states who have declared that you can't bind a future legislature. It's based on that same authority, that the Constitution gives the legislature authority to act. And if one legislature can take that away from another one, it's unconstitutional. And so as you know, I think that, anyway, that's the reason that we've gone the other direction in this amendment. And that's also consistent with a number of other statutes in this state that have used the same approach that this amendment uses. That is to include a declaration that the the fund is intended to be inviolate and a perpetual fund that can't be invaded by the legislature. In fact, the language that I've used, and you'll see it's the same in all of them. You look at the amendment on page 3, line 11. That language towards the bottom, it says monies deposited into the reserve account created by this subsection are intended to be inviolate and constitute a permanent or perpetual trust fund. That exact same language is used in, I think, about half a dozen other, maybe 5 here, other statutory trust funds in the state of Wyoming, including those that we talked about a little bit earlier, like the Wildlife and Natural Resource Trust account. That's how our legislature has tackled that in the past, by trying to express a very firm intent that they be inviolate.
Mr. Chairman? So with that, Ian, does it actually do that? So when we say it, these subsections are intended to be inviolate, doesn't mean that they're guaranteed to be inviolate. So we could still go in and create mischief should we have a majority of the votes. Am I correct on that?
Mr. Chairman, yes, that would be my reading of the law, the Constitution, that we can't bind another legislature. In fact, the Supreme Court has some kind of correct language on that language. It says no one legislature has a vested right in the current status
So,
of
Mr. Chairman, follow up, is there something magic that says we can't do constitutional amendments for reserve accounts? Or just, we could do a resolution, just like any other constitutional action?
Sure.
If we so felt that it was
Mr. Chairman,
warranted?
Absolutely. We could make these accounts inviolate. We would just need to do that through the Constitution.
Thank you.
Mr. Chairman? Mr. Chairman?
Please.
Thank you, Mr. Chairman. Question for Ian. And Ian, when we make the funds, the reserve accounts inviolate, are they really inviolate if ultimately the point is that going back to the Monte Carlo simulations and the purpose of expanding the reserve accounts is their intended use is also, in addition to having this additional investment opportunity and income, is also then to have an extended time where the reserve account can make up for differences between the spending policy or the guaranteed amounts for the intended recipients of those funds. So if we do it violent, we have to carve out, or is that a natural exception because we know that's what they're for? And so they're violent except for that particular use. Make sense?
Mr. Chairman, yes, and Chairman Perkins, that's exactly right. And I'm sorry you don't have the benefit of seeing this amendment in front of you, because let me read the rest of the language that exactly accommodates that situation, because you're absolutely right. These reserve accounts were never intended to be strictly inviolate. In fact, we set up ways in which they can be invaded to handle our spending policies. So the language we have on all of these says, except for monies specified by the legislature that one, guarantee the obligations of the permanent Wyoming, I'm reading the first one, that guarantee obligations of the permanent Wyoming Mineral Trust Fund. Two, monies to be deposited back into the permanent Wyoming Mineral Trust Fund. And three, monies acting as guarantees for other obligations as specified by law. Then monies deposited in the reserve account are inviolate. So that's exactly right. Each one of these amendments provides for three exceptions to the inviolate nature of the reserve account. That is to handle the three ways right now that those reserve accounts are used and monies within those reserve accounts are used.
Okay, further questions?
And Mr. Chairman, I should point out that that third exception, monies acting as guarantees for other obligations, with this other amendment that you've passed, I need to take out that language, because what you're saying is you don't want to have other obligations signed up on these.
And so Ian, where do you have the funds coming from on each one? Are they all coming out of the LISRA?
Yes, Mr. Chairman, that's correct.
So my question to the committee is, for example, on the school side, we have a surplus of roughly 900 million. Why wouldn't we use that surplus on the school side to fund the school component and not the LISRA?
Say that again. Could you say that again?
Yeah, the source of the funding of the 300 and some million for the reserve account for the common account. I think the money should come from the surplus that we now have in the school fund, on the school side, and not take it out of LISRA.
Mr. Chairman,
Go ahead.
can we just dispose the amendment and then go on to that question?
Yeah, that's fine.
Mr. Chairman, one other question.
Yeah, go ahead, please, Mr. Co-Chair.
Thank you. And then I also want to make sure that we're all on the same page. And Ian, in addition to the inviolate nature, we also permit the inviolate nature does not stop the automatic overflow into corpus when we exceed 7X. Is that correct?
Mr. Chairman, that is correct. That's right. And in terms of the Permanent Mineral Trust Fund, the way we term that, we say monies to be deposited back into the Permanent Wyoming Mineral Trust Fund. So those are the tip amounts above the 7 times spend.
Yeah, and the tips are all still in there, so I think it's implicit.
Question?
Question being called.
Mr. Chairman,
Go ahead.
thank you, Mr. Chairman. This amendment kind of reminds me of a fairy tale that I used to read my kids when they were small. That was the frog and toad stories. The frog had some cookies and he wanted to eat them, but he wanted to have cookies in the future too. So he decided that he was going to take and put the cookies up on a high shelf where he couldn't reach them. However, the desire for cookies were overcome. And he got a ladder and he went up the ladder and got the cookies and he ate them. So I think that kind of is the same as this amendment that says that we can't use this money for other purposes. I think the legislature may have a need for funds. Maybe there would be some major investment we'd want to make in the future, and this would be a source for those funds. So I think that I would be opposed to this amendment for that reason. Thank you, Mr. Chairman.
Is that because you don't like cookies?
I love cookies, and I would go up any ladder to get cookies. I have mine. Now, if we don't want to have those cookies available, then we need a constitutional amendment that would take away the ladder. Thank you, Mr. Chairman.
Well, and I think that, that a constitutional amendment, and maybe in the works, or, but that, we want to get the cookies baked first. Okay, any other comments?
Mr. Chairman, I do have one.
Okay.
Just to make this real clear. So as you vote on this amendment to use this inviolate language, do you want me to take out that third exception for other obligations? That's correct.
Correct.
Okay. The guarantee, right.
Okay, as amended. All those in favor say aye.
Aye.
Those opposed, that motion
No,
carries. Almost unanimously.
no.
Okay, now we're back on the bill. Any other amendments?
Mr. Chairman.
Please.
Mr. Chairman, so looking at, looking at these account balances, the end of this biennium, the LSRA is 2.93 billion. So we've just proposed that we save 639 million of that. And that'll, really incredible, and that doesn't grow government one bit. I mean, it's really increased returns and decreased complexity. 639 million. Then the LSRA is profiled to be then at the end of the next biennium, 3.7 billion. So this expenditure of 639 million, still going to leave it at 3 billion. So here's my thoughts, and I talked about this before, particularly about the Wildlife Trust Fund, and it's nearly 200 million, and it's a statutory account, but if we could amend that to make a reserve account with that and put it on a 5% spending policy, that would cost us, did the math on it, confirmed it with LSO, it'd be 28 million to create a 5X reserve account for the 188 million in the account. And then that would guarantee about 9.8 million a year. And I spoke to good senator over lunch, and I did call the director, and not that that's, but I mean, so I think it's an idea worth putting in this bill and saving an extra 28 million bucks to increase our returns for the Wildlife Trust Fund. Even though it's a statutory reserve account, I think it's an important piece of that. And then, so that's one part of this. The other part was to fill up this Wyoming's Tomorrow. And so we've established the fund. It's a constitutional fund now. And the idea was to fill that up to 100 million. And then that would do scholarships for about, I wrote it down here, it's about 1,400 people a year. And really fund some of the programs that we passed. You know, Senator Kinski had Wyoming Works, first thing cut and budget cuts. And I just think this is a way to kind of endow that, to get these workforce training things going. And so we put 10 million in it. The number on that would be 15 million to do a 5X on that. So the total would be 105 million to have a reserve account and have that thing done. So my amendment in concept is to really get these two big reserve accounts or these two endowments set up and reserve accounts funded, and to roll with that and put that in this bill. So that's my amendment, Mr. Chairman, is to endow the 28 million for the Wildlife Trust Fund on a 5% spending policy, and then to fund the Wyoming's Tomorrow at its 100 million and with a 5X reserve account as well. So if I have a second, I'm done talking anyway, but we can talk about it. Thank you.
I'll second for discussion. Any comments?
Yeah, Mr. Chairman.
Go ahead.
Unfortunately, my question's for Patrick one more time. Sorry about the runaround. You know, one of the focuses of this bill is that we're talking about total return on these pools, and part of the selling of this is obviously that, you know, we don't have dead pools of money. So along with the simplification piece, we're saying we're just not going to let this money lay around not earning. So my question is, on these two additions to this, would those two accounts qualify to be invested in that total return environment, or are these just going to fall in the category of low return investments?
Mr. Chairman, Representative Obermuller, that was, when you're going through this, that was my thought exactly. I don't know how you would actually look through and do it, but if you actually had this fund that had a reserve account, that would negate the need for it to be into both of the funds, to be into Pool A. It would be creating more work and more funds and so forth, but by having that reserve account, it would then actually fall into that same category as the rest of the funds that have a total return strategy. You wouldn't want to have a reserve account and have a lower risk strategy because you've filled those spending policies. So yes, you are correct. If you did that theoretically without going through the accounting and all the other issues, it would be from a purely investment total return perspective, you would want those two funds into a total return rate strategy.
Okay, yes, that was my question, if they fit into that broader picture. So
that is
one of the
correct.
advantages of it or side benefits, it would
From an
fit into
investment
that.
perspective, that is correct.
Okay, thank you.
Mr. Chairman,
Go ahead.
can't help myself. I like sometimes the way Representative thinks, and then sometimes he really worries me. And my concern is now we're creating we're dealing with existing reserve accounts as they are and funding these for specific obligations, and being a proponent of some of the things that my colleague presented. I think if we start cluttering this up with creating new reserve accounts, and now we're going from 687 million up to back pushing $900 million. 772.
And change.
It gets back to our earliest discussion, and I think good Representative Harshman said he really liked 5X because of the number. I think we've exceeded that threshold, and I think this jeopardizes this entire effort by adding those two reserve accounts into this bill.
Yeah. And
I think they should be done as a separate bill,
And
each individual.
I would agree with that. This bill is going to be a load by itself. And in fact, we talked about in our previous meeting and getting together with leadership to give us a chance and actually bring the experts in. Patrick and RVK will come in and explain it to the bodies in a joint conference to be able to walk them through it. And so it's not us selling it. It's the professionals selling it and explaining it, because this is totally unique, and all of a sudden it's a $700 million price tag. And so the idea that now we're putting policy in it and we're complicating the bill. And so I would concur with that. Now's not the time.
Mr. Chairman,
Go ahead.
Mr. Chairman, and I appreciate where Representative Harshman's coming from. I don't want the perfect to be the enemy of the good. I think if this bill just dealt with the PMTF and the Common School Public Land Fund, that's an easier case to make to the body. Then we've loaded in 3 more on top of that Whether those three can survive the process is another question. And putting two more on top of it, I'm afraid it's going to stretch. I think I'd be on and against any such amendment. I'd appreciate it, but just, this isn't the time. Let's do incrementally, get done what we can.
Okay, further comments? Okay, all those in favor of the amendment?
Can I just, yeah, and I appreciate it, fair enough, and I think you're probably right, you know, you're probably right, but I think, I'll just go ahead and pull that amendment back, Mr. Chairman, I think, and I think I will ask for, I'll get working on a bill draft for that. I just think the Wildlife Trust Fund, those two are gonna be really important, and I think we're gonna have other committees that have sponsored these trust funds, and we're becoming experts in Wyoming, man, at taking these one-time deals and setting them aside to generate forever. So we wanna keep that momentum going, and I don't wanna do anything to jeopardize this at all. This is huge. This is a game changer for the state. So, but I was just trying to keep moving the ball down the field, making the game even bigger. But I appreciate your sentiments, and I'm going to withdraw the amendment on that, Mr. Chairman. Thank you.
No,
Go ahead. Other amendments?
thank you, Mr. Chairman. So I would like to make a motion, section 2, page 10, A Romanet 2, which is the funding of the reserve account for the Permanent Mineral Trust Fund. And I would move to delete that, which is page 10's line 4 through 8. And my logic is, and I kind of, in my question to Mr. Fleming, so by doing that, we would generate increased investment returns of $90 million over 5 years. The corpus is already invested in total return. So there's no impact there. It's merely how we invest the reserve account. And I look at 279 million, and I think about saving 18 million in terms of construction costs. Just pick a couple construction projects that need to be done. And the cheapest day to start them we already missed the cheapest day. And given the inflationary costs and the rise in costs, I think that money can be put to better use and actually save the state more than $18 million a year. And it has the added benefit, I mean, we could just strike the Permanent Mineral Trust Fund from the entire bill. In terms of simplification that Senators Hicks and Kinski talked about, that makes the bill simpler. So that's my motion.
Is there a second? Seeing none.
Worth a try.
Any other amendments?
Mr. Chairman,
Go ahead.
so first,
Mike,
so if I could get the treasurer and the CIO to come up, I've got a question about the logistics. I think will help edify what I'm going to do with the proposed amendment. So the current effective date on this is July 1st. So basically, it moves these funds and establishes these reserves accounts. It's there. They're set up. The question I have is, so we still have to go through asset allocation and all these other things. We need to get the accounting system set up to be able to track this. All that, what I would say is infrastructure through the software, hardware program and all that stuff. So how long is that going to take? Any idea, or have you given any thought to be able to do all that stuff wants to just, I mean, just because we move the money into these reserve accounts and set them up.
Yeah, on the accounting and all those things, I think Katie should probably answer that, but we've talked to her about, setting up, what it would take to set up those accounts, and it doesn't take that long to set them up. We just need to make sure that we identify them so we know what accounts they are. So after you pass that, those things on that side, as far as getting that set up and getting it into the accounting system, shouldn't take more than I would say not more than a month, if that. but Katie can answer that in that regard. I'm sure she's here. Still here, Katie?
I'm still here, Treasurer. Thank you.
Okay. I hope I didn't oversell you. You can do it in 3 days, right?
Half of a finger. No, thank you, Treasurer and Mr. Chairman, Senator Hicks. Yes, the structure is there with us doing that COA shake and jive with phase 1 of the accounting system. It becomes a lot easier to adapt to a different, to less pools, essentially is what's happening. We're going from 15 to 5, maybe 6, right, with the TRR liquid. So you're condensing down what you already have and shuffling and driving the funds allocation to those new pools in which they participate. It's not simple, but it's far easier and a very attainable task to have now that we have our chart of accounts. So I would say the treasurer is pretty well on target. Obviously it would take a month or so to get that shifted over. We would do that in a UAT environment, a user accepted testing environment, and we would test it. We would test it as much as we possibly can until we go live July 1st to make sure everything is being reported, because as you guys all know, we're working through our reporting. We're working through our automation. So we have these spreadsheets spitting out into reports instead of us doing it manually. So we would have to test those reports as well, because I don't want to miss a beat. I don't want us to be in a pickle where we've changed structure and now our reports aren't working. So you would want to get that up and rolling and get that into a testing environment so you can start playing around with potential issues that you might come across to work out those kinks. So
just to follow up there, Katie, so, part of it is to set the system up, but then it's to test it, and that includes the distributions and make sure they're crediting the beneficiaries for each one of those when those distributions come out and some of that stuff. So it's going to take some testing of the program, which I'm anticipating would be over a series of months to run through those.
That would actually simplify it, because the planned sub-accounting, you're doing it for all those different assets, spread across the different, and which all of them aren't equally spread across all of them. This would equally spread them all across, so that the math would be much, much simpler.
So, Mr. Chairman, so a follow-up side, so if we do this, we still have to go through an asset allocation with SLIB.
And Mr. Chairman, we'll have to wait till RVK does their capital assumptions, which will be just right after the first of the year. And Patrick can go into that. The process wouldn't be, I would say, anything different than what we're doing now for, 6 or 7 or 8 funds, whatever ends up in there, as to one total fund.
Mr. Chairman, Senator Hicks. So session is theoretically going to end first part of March. We have now looking to set up the Investment Funds Committee meeting with RVK to go through the preliminary asset allocation, which we do every year. This will be a bigger one than normal, but still very doable. Would be mid-March. Then we present it to the SLIB board. We go through and go all those iterations again. And then the June SLIB meeting is the time that we typically would then implement and change our investment policy statement. And at that point, then we would then be able to be authorized to change the asset allocation and so forth for that July 1st date.
So, Mr. Chairman, that comes down to the proposed amendment, and I think Patrick just hit it. We don't really have any trigger date for this to happen. We have a procedures in place right now. So I'd like to just make sure that we follow that existing procedure. And so someplace in the bill through a conceptual amendment that we would want to include the language is once the state treasurer's office is certified that the accounting is all in place and SLIB has done the asset allocation, that's when this goes into operation. So we've got the effective date, we've set the money up, but we want to make sure that you guys have certified that everything's run, you've run your stuff, you certify that, take that to SLIB. SLIB looks at the asset allocation, they make a determination with consultation with RVK and the Investment Funds Committee. That's the trigger that actually starts the investment. And I think we need to capture that process in the statute so everybody's protected and understands when things are going to happen.
And would that include having their back office or middle office or both up and running so that, for example, your daily trading is being tracked and monitored? And what we don't want to do is have any issues where we just get behind again, so.
Mr. Chairman, neither do we.
I know,
So,
but we need,
but this is
I'm
our,
saying is, how do we know when that time?
Yeah, it is.
well, if you set so the way that this works is, as Patrick said, we go through this process anyway. We go through asset allocation. This is the timing of it. So whether you put it in a bill or you don't put it in a bill, that's what we're going to do. If you make the effective date of the funds July 1st, so we prepared that timeline for you at your last meeting to show you that what we would be doing, and that's what Patrick just walked through again, and what Katie reiterated. We have a plan. If the bill passes, that's when we start planning. We start in March, we work on our asset allocation with RVK, we start to do our planning with our accounting system. The one thing about this, like Katie mentioned, it's much more versatile now. So that the whole idea, so this is a doable thing. It's, well, like she said, it's still gonna take some gyrations, which is why we've planned from March through June to work it out and parallel it. So,
Mr. Chairman,
Go ahead, Mr. Co-Chair.
thank you. Mr. Chairman, just following up on that, Don or Katie, and from what I'm hearing, my concern is, I don't think it's not the asset allocation issue I don't think we're worried about. I think what we want to make sure is we've got the mid-office and back office problem solved. And again, I think Katie hit it on the head in what she said just a minute ago, that this is about the reporting. And so from kind of where we're at, don't we need to get through phase 2 and have phase through, do the beta testing on phase 2 and have that complete before we know, and then once we verify the reporting's accurate, wouldn't that then be the time where you would know that if we do this, that we've got the reporting and the automatic reporting, all that will happen in the mid office and back office, and we know that that'll be proved up? Is that not right?
So I think that deadline is January of '23, right? 24, I mean. Yeah.
Mr. Chairman, I'm not quite sure about the deadline for phase 2, but just to jump in, Mr. Chairman and Senator Perkins. So it kind of needs to go almost simultaneously a little bit, because if we're going to be building all of these reports and automations based off of the structure we have now, I don't want to have to be reliving all of that for a new structure. So it's kind of like, now's the time. If we're going to do it, now's the time. We're in that phase to finalize these reports. If I can give my accounting system vendor some idea of where we're going and what potentially could be happening, that helps us ensure that structurally those automation reports are pulling to the components and the data in the system where it doesn't necessarily matter if we go down to 5 pools to 15, or what fund belongs in what pool, how that's necessarily distributed, things like that. If we can start building that, and we're already going that way, I'll be honest with you, just because I wanted the system to be adaptable. I wanted it to be something where it was ready for anything that could happen in the future. Say we get 20 pools, God forbid, that would be horrible. But if that happened, we could be able to do it. And so now's really the time. We're in the weeds of it. We're in the thick of it. So I think it's kind of a perfect storm to do it in as we're finalizing those things. As far as the middle office, from my perspective, trading doesn't change. It doesn't matter. At the end of the day, a trade is a trade with a manager, with the internal manager. It's our job on the back office to allocate that and to make sure it's going to where the investment team wants it. So again, 5 pools, 15 pools, we'll still trade. We can still trade and function that way.
Mr.
Chairman, follow up?
Please.
Thank you. Thank you for that, Katie. And I think we're saying that, and maybe I've just got but ultimately I think that's the purpose of phase 2. And if we need to do this in order to get that done, I like that. But what I want to make sure is that we, before we pull the trigger and necessarily make all of these allocations and get started down this way, what I really want is for the new accounting system to be designed and proved up to some, whether it's the treasurer, the SLIB, or somebody, to come back and, like the vice president was talking about, certify that to make sure that the reporting is going to be is accurate, and that reporting is based upon the new system and not upon new spreadsheets or simply revising the spreadsheets so that they're outside the system. But really want to see that back office and the software is. If we need to do that and authorize this, maybe we can phase this in. But I think we're trying to get to the same place. We just want to make sure that it works in the new system, and we're not just creating more spreadsheets that complicate the issue and cause us to slow down later on. That's all, Mr. Chairman. Thank you.
Mr. Chairman. So Senator Hicks had a conceptual amendment that would give the treasurer's office a little bit of wiggle room instead of a July 1 deadline. I'm inclined to second it, but I'm hearing the treasurer's office saying they don't want that.
Well, I think they need to respond to make sure we're on the same page on what this needs to look like before it kicks off. And whether that's January 23 or July of 20 or 24, or July or August or September of 23. So what's your comments?
Yeah, Mr. Chairman, I think a lot of that is the testing that we're going to be going through, looking at, as soon as, and of course, I'm sure, we'll come up with the protocols for the testing before the bills are passed, if we're reasonably certain that the bills are going to, pass, which I think you guys can get done. But that testing, from March, April, May, and into June is going to, and through the year end is going to tell us a lot. But Katie's 100% right that if we go to July 1, then we can report all of those accounts in 1 year under the same protocol, and then switch over to a protocol that has less accounts, so you're not trying to do two types of accounting in the same year. So that's what she meant, I think, by the perfect storm, and that's why we decided, to make sure that we implemented our accounting system on a biennium, and this would be halfway through the biennium, but you have that year where you can switch over without having to do two things differently. And so that's, I think, where it leads a lot of benefit.
And that's your target anyway, right?
Yeah, and that's our target anyway. And frankly, because it makes things simpler, that's one reason for the target. I think what we'd really like to make sure that is that the reserve dollars that would come, into an agreement that those are necessarily maybe in holding accounts, so we can switch those over into or develop that type of account. So those things may happen before July 1, but that's, I think, really up for Katie to come back to us and say, and then come back to you and say, we need the money in this account at this time. So when we switch over, we know that, it's going to work.
Chairman,
Go ahead.
if you make that effective date of the transfer, we would prefer not a holding account, honestly, sorry, Treasurer. That makes it a little more complicated. So if you just make the effective date of the bill July 1st, the transfers occur on July 1st, we can put the money where it needs to go, we'll be ready to go.
So I think what we want, the concept is, we can make the bill effective July 1st, but the implementation of it is subject to, you have a functional system that basically is checked off and agreed to by SLIB. So when you pull a switch and the light goes on, we know that your accounting back office, middle office is going to work, and that it's automated.
With that, I will second Senator Hicks's conceptual motion.
Go ahead.
Mr. Chairman, I just want to make sure that when we're talking about this, it would be, without looking at the asset allocation, it would be extremely difficult thinking that as of July 1st, we're going to trade $5 billion in one securities and hire these managers and so forth. Typically with asset allocation, for instance, last asset allocation, we have a 3-year runway to implement these changes. And many of these assets, you don't want to just throw in at one time. You want to scale in and have pacing schedules and so forth. So just so we're clear, July 1st would be a time that we would start. I would agree with Katie and what they're doing. If you're saying, well, we're not going to start until July 2024, what have you, that's more problematic from us on the investment side. You want to look at, okay, here's a great opportunity set. Let's focus on this first and so forth and scale into these trades. So that conceptual component would make a lot of sense from the investment perspective to allow us the time to implement the strategies and the trades.
And Mr. Chairman, I think it's very important that, you know, the intent here is to make sure that everybody is on the same page is exactly where we're at. No misunderstandings that something happened with the treasurer's office and then didn't go, that you guys have all the time to run your test, and when you're done, you come back to SLIB and say, we've run all the tests, we're ready to go, this is what we've done, questions and answers, and then SLIB says, go. Says, run with it, because then everybody's got ownership and everything that's happened up to this page. And I just think it makes it cleaner. The other thing, I think it gets more buy-in, that everybody owns it now, right?
Well, think of asset allocation more like running a mile relay, and you got 4 batons pass-offs, because that's how you implement your it's not a bam and the race is on. The race is on for a quarter, and I mean a 220, a 220, and 220. Yeah.
But I think, and I agree with that, and I think a lot of people don't understand that, and they're afraid that one guy's going to run the whole race. And so this just says, no, there's a bifurcated process here. You got to buy into it. This is where we're at. And at the end of the day, I think it's just good business and provides buy-in and protection for everybody once we stand this thing up, if we get that far. So that would be kind of the conceptual amendment to get something drafted up to that effect, and would say would work with the treasurer's office.
So Ian, questions about that?
Mr. Chairman, no. You know, if you need a lot of detail, I guess the only question I would have about what kind of detail do you want to provide SLIB on that decision? Or is it fine to say they report to SLIB, SLIB makes the final determination that everything's ready to go, and then within 90 days of that determination, they're starting to make those trades?
When SLIB says go, there's no 90 days.
Yeah.
It's just, they can go.
Yeah, Mr. Chairman?
Go ahead.
Thank you. And right, there's no 90 days. I mean, quite frankly, again, I think the concern is we just want to make sure, you know, we've had some issues in the past with it's not with the trading office, it's not the investment that those guys, you know, these guys will do the right thing. We're not worried about the investment side. We just want to make sure that we've got our back office is up. And so as we make these switches before we move all this and move it into this kind of, whether we call it the endowment model or the more uniform investment model that we're talking about. We just want to make sure that our back office is there, and that we're not out in front of them too far again. And that's just, I think that, so again, I think what was just said is just right. It's not a 90 days. It's just when they certify that they're ready to go and it's been tested, that we're ready to go with the accounting system, the reporting system, that then that's the certification that they're ready to go. And then the money starts, and it'll get invested however in the proper time and manner in which the investment folks do their thing. That's the way I see it. I think that's what the Vice President's saying too.
Okay, Ian?
Mr. Chairman, one other question. Brian and I were discussing, it is true then that we want to allow the money to hit the accounts upon that certification? Is that correct? Okay. And not before then?
Okay.
Wait. Mr. Chairman, I think we set up the money transfers on July 1st of 2023. Otherwise, back to what Katie was saying, so the money transfers there, it's just going to sit there until we get the certification and SLIB says, go do it.
Mr. Chairman?
Please.
So do we need to transfer, or do we just allow it then to be, or just that the expenditure occurs when that happens? So we don't have to necessarily have a reserve account or holding account set up. They can just pull it out of the general fund, or, they just pull it out. We don't have to create a separate account, or maybe the vice president wants a separate account. I'm not sure.
Well, it's where the money is going to be anyway.
Mr. Chairman, it'll be in the LSRA, right? So so you would just transfer from the LSRA to the individual reserve accounts
On July 1st.
on July 1st. Thank you.
Yeah, and more likely than not, we're going to get the answer about moving forward with the asset allocation, the first week of June, because that's how we normally do it. So there isn't really a need for a certification, because we'll have the asset allocation in place in the implementation. We work with RVK, and as Patrick said, that these things are paced, so you don't have all your eggs in one basket. So, call it certification or whatever, it's just a standard operating procedure, what we go through.
Question?
Well, any more amendments? I have one amendment.
We didn't vote on that conceptual.
Oh, on the conceptual amendments, any other comments? All those in favor say aye.
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 All those opposed? Representative Larson? That passes.
Chairman, I would propose on page 9 that on line 36, we strike through legislative stabilization reserve and substitute school foundation program. And so, to your point, when we first crafted this bill and contemplated it, we had no idea that we'd have the revenue coming into the school foundation account that we have. And so this would allow us to take it out of the school foundation program to the common school account. And then as we look at some of the concepts, the bills that Representative Harshman talked about, it allows a little more, I think, flexibility pulling that out of the LSRA.
Now, a second for discussion. Go ahead.
Mr. Chairman, I think the only issue is I look at the SFRA is where the excess will flow, and it's only 158 million. So can't all come from there, I guess, is what need 347, is that right? Am I looking at the wrong one? Well, then if you take it out of the school foundation program, you're going to create a deficit, aren't you? School foundation program. I'm just looking on this. Okay, I'm just looking on the balances that was sent to us this week. I don't know, at the end of the 23-24 bienniums.
I think that the balance on July 1st is supposed to have an excess of $900 million in it.
950.
Yeah.
I think that's potentially at the end of the biennium. I'm not sure.
Yes.
Maybe we can get some clarification.
So, Mr. Chairman, and I'm basing the amendment that it was going to be available
Yeah.
at this time. Staff, can you give us a little better feel of?
Mr. Chairman, Representative Larson, just looking at the most recent profile for the school foundation program for the 23-24 biennium, the total balance available in the SFP is over 950 million. I'll just confirm that with Don Richards and get right back with you.
Yeah.
Good move.
Maybe we can just say it's.
Mr. Chairman, sorry to interrupt. Mr. Chairman, that's the 950 million expected balance is as of June 30th, 2024.
24, not 23.
23.
Property taxes from this year coming in next year.
So do you want to you want to amend your amendment?
I do, but do we want to do that?
Well, it could come from the LLSRA, but to be replaced by the
There
those
we go.
funds in 2020.
Good idea. So did you catch that, Ian? So the language will stay the same, but then to be replaced as the school foundation program money comes available. Friendly amendment.
Okay, discussions on the amendment as amended. All those in favor say aye.
Aye.
All those opposed? That motion carries. Anything else? Any other amendments?
Mr. Chairman, I just want to, if I could ask Patrick again, I just want to, as we're going to all vote and pass this, I'm sure, but I just want to clarify, here's what I have in my notes. That 313 million over the last 5 years, lost opportunity, common school account, 70 million permanent trust fund, and 140 million in the reserve accounts, about 510 million total is what I wrote, basically 100 million a year. Is that the?
Mr. Chairman, Representative, yeah, the breakdown, 313 comes in, and all we were doing was just taking
Sure.
the difference between the 5-year returns. 313 was common school. 370 million was to aggregate all of the funds into a total rate return strategy. If you took higher ed, Hathaway,
Okay.
common school, PMTF, well, PMTF's already there.
370 of that. And then
So-
140.
And then 140 was split between the two reserve accounts. PMTF reserve and the common school reserve.
So 100 million a year. And so my comment, Mr. Chairman, is that's basically 2/3 penny sales tax. It's a significant amount. And I think if any of us could say, hey, I'm going to save $600 to make $100, pretty good investment. And so really appreciate your work on this and everybody's work on it. It's going to be really a big bill.
Mr. Chairman, Representative, just to be clear, though, this was just a point in time of
Sure.
5 years. We could have done 10 years, we could have done 15, but you have to look at some time to have some comparable. But, as they say, past is no prologue. But anyway,
Yeah.
that is what happened. That was what it would have been over the last 5 years, approximately,
Thank
using
you.
those numbers.
Well, it's a better way to invest money, no matter how you look at it.
Yeah, yes, if anyone would say that cash will outperform a total rate of return strategy over a long period, I would argue vehemently with that one, that it's
Okay,
historically has been inaccurate.
question on the bill. Roll call. As amended.
On 23 LSO 0181 as amended, Senator Driscoll. Aye. Senator Guru.
Aye.
Senator Hicks. Senator Kinski.
Aye.
Senator Nethercutt.
Aye.
Representative Hallinan.
Aye.
Representative Harshman. Representative Larson. Representative Obermueller. Representative Schwartz. Vice Chairman Nicholas.
Aye.
Chairman Perkins.
Aye.
12 aye.
So what's your preference?
Give it to them.
Senate.
Okay, Senate file it is. All right, next, Ian. Bathroom break. All right. We'll be back in 10 minutes.
Yeah, Mr. Chairman, we have a performance compensation.
That's the bill, is that? Or
Well, the agenda
report?
has updates from, yep, retirement system, yep.
Doesn't matter, however you want to do it. It's the David Sam Show, off we go. Now we got Black Bart up. All right, please proceed. Go ahead.
Mr. Chairman, members of the committee, yes, it's us again. We have appeared before this committee fairly frequently, but good chance to meet with you again. To update you on performance compensation. Last week, we did submit to this committee, as well as the Joint Appropriations Committee, our statutory annual report due to you by 1 November. That report was pretty much as one would expect. It's exactly what we reported to you previously. The team did exceed their benchmarks for the performance period. For the 3-year performance period that was analyzed for purposes of performance compensation, our team ranked in the 9th decile. That's a top 10% performance compared to the 60 or so funds measured by our investment
That means there's a little
consultant.
room for improvement.
That's right. So they did qualify for a full measure of the performance compensation. Mr. Chairman, I'll pause. Are there any questions on our report?
Questions? Go ahead, proceed.
Seeing none. Also, subsequent to the last meeting of this committee, the committee formed a subcommittee to look further into recommendations to change performance compensation during the upcoming session. And they asked us for recommendations. We submitted to the subcommittee a memorandum with 2 recommendations. One was to adjust base pay, which is limited by a budget footnote, and the other one was to increase the percentage of participation in performance comp for the most junior members of our team, which we refer to as the investment analysts. The draft bill before you addresses that. It increases it from a 25% of base pay eligibility to 35% of base pay eligibility, and we regard that as progress. That's where we're having some more competitive issues and where we think that we might lose some talent, and that's the talent that we kind of grow. We take them in very junior, we train them, we provide them certification, we spend money on them, and we don't want to lose them right away. We recognize that eventually these are young people, we're going to lose some, but 35% is a good measure, and we think that's a good part of the bill. The other part of the bill contains a recommendation from the Treasury Department, which was really almost a recommendation from the retirement system as well. It just didn't quite make it into the final version of the letter we wrote to you. It's kind of left on the cutting room floor. And that was to have some sort of a relocation allowance for somebody that we might hire for out of state. And yeah, I even had the number in $10,000, just like the draft bill has. So we also think that's a useful thing. We thank the Treasury for going ahead with that. We kind of said, well, it's kind of ancillary. We won't put that in. We'll keep it somewhere. But anyway, it's there. And I think both aspects of the draft bill before this committee are commendable. The main recommendation, of course, is to increase base pay, which is limited by the budget footnote. But Mr. Chairman, I believe that's going to be done with another budget footnote and probably not the topic of legislation in this bill. Am I correct in that?
Oh, I don't know the answer to that. We could do it either way.
Well, we presume that since it's not in the draft bill that you'll address. That is our primary recommendation. I just remind the committee that the basis of performance compensation, the foundation of it, if you will, is base pay. Mm-hmm. And so we have to maintain base pay. Otherwise, we've built a house that doesn't have a sound foundation. And I think everyone recognizes that.
Well, just remind us again what other folks are making. I mean, the idea that, it seems like, obviously, they're, compared to other state employees, it's a lot of money. Compared to their contemporaries in the world, we're still at half of, or less than what they could make elsewhere. So,
In general, our base pay puts us in kind of the bottom quarter with performance compensation, which not every system has, although it's becoming more common. It gets us towards median. So it's been very important. I think if we had not implemented performance compensation, that we would have had turnover on the team. We wouldn't have the investment performance.
I don't know if it'd be median, though, if you take McGash.
That's right.
It's a big
Right.
difference. Yeah.
But I think it's made a big difference. And we've retained, we've had very little low turbulence on our team, and it's produced very impressive investment results. The outperformance just from above the benchmark over 3 years is about $444 million. That's contained in our memo. So it's important to have stability on the team. We won't have the perfect stability all the time. People move for a lot of reasons. But I think addressing compensation has been very important, and it's to the efforts of this committee that's been done.
Well, it's amazing, the turnaround for state retirement. And so kudos to you guys. It's a long time coming. Finally, we're there. So,
yeah.
Okay, questions for retirement? All right, go ahead.
Thank you, Mr. Chairman. When the subcommittee asked the State Treasurer's Office and the Wyoming Retirement System to present these ideas to it, we did get together, we concurred with our recommendations, and Dave did a great job summarizing what our requests were. These are the bill reflects what the subcommittee returned from those recommendations. If you do look at our memo, the primary request was to increase the salaries, the base pay salaries for our investment professionals. And we did try to tie that to, or we did tie it to a request based on inflation, given that is the requests that were made, or the increases that were made for the rest of the state employees on July 1st. The investment professionals in the Wyoming Retirement System office and in the State Treasurer's Office were not eligible for those increases because their salaries are set in the budget bill, via budget bill footnote. So that is our primary request, and as Dave indicated, our understanding is that will be addressed in a different place in the budget. The next things that we asked for, we also requested remote work. You had charged us to come up with some ideas about what are some, are we thinking outside the box? So Patrick had an idea, hey, with private equities, when we were looking for a person for private equities, senior investment officer, he said, you don't technically have to do that in the office, but we'd like to have some office presence, but we don't have a budget to reimburse that person for travel to the office. And so that was one of our requests that the committee said, yeah, no. So we said, okay, that's just fine, the subcommittee. And then the subcommittee did include the $10,000 for relocation expenses for folks. That is in the bill that Dave mentioned. And then the last request that we made that the committee did not move forward was to implement performance compensation payments for investment staff positions. And so that's the difference that you'll see in the memo that we submitted from the bill that was drafted. And we are appreciative of any consideration. So thank you.
Mr. Chairman, the point of retaining our staff is so very important. And you talked about the rest of the state employees would look at it and say, yes, that would be different. But in all fairness, it is different. And the amount of money that changes, 1 basis point difference is $2.5 million, and that is a big deal. And being able to retain these members, as you know, we've lost, including Lisa, the attorney, we've lost approximately 30% for higher paying salaries, and the ability to, that we're on hold to try and get these people. We don't have this plethora of staff to be able to say, oh, okay, this person's out, this person's in, and keeping them is just really, really important. And they all could go somewhere else for more money than what we're having here. And what we're talking about is not some egregious amount. What we're talking about is just an inflation adjustment. So when we talked about, the 20-odd% difference from when we first implemented this plan to where we are now, there hasn't been a change. And if you just look at the difference in the overall inflation measured by CPI, for instance, in June, the overall national average was 9.1, and Wyoming inflation was 10.1. So, it's not only just the overall inflation rate, but Wyoming inflation is higher than other states as well. So from that perspective, I think it's really important for the staff just to have that higher level. And we're going to talk about the changing the bonus later on the next one, or should I remember? So the other component of is keeping the analyst positions. And so what we'd ask for is moving from the 25 to the 35% differential. And the reason being is the amount of money that we're talking about is different. So if you remember, the bonuses aren't paid out in 1 year. They're paid out over a 3-year period. So you get 25%, 25%, and 50%. So when you look at it, to keep that person, for them to move and lose, the 25% of a smaller amount is not that big of a deal. And that is where those are the people who are hopefully going to be running the institution down the road. And those are the people who we really want to keep. And so that to us, and Sam and I, we had talked about this before, about trying to keep the younger ones and doing something different. So that was the recommendation why we were trying to get an additional, a higher bonus for those younger paid employees to keep them.
Well, and why don't you, I think it's useful to know the numbers. I mean, if you're making, what's their salary gap?
It's capped at 70,000.
So, I mean, so 25%, if we increase it to 90,000, you're only talking about a couple $1,000 bucks. I mean,
Exactly. And then last but not least, on the staff, when we first did this performance package, the governor, then treasurer at the time, was very adamant about trying to do something for everyone. And when we passed that bill, the thought was, well, let's just get this across the finish line, and then we could address it at a different time. And so this is the later time that we had talked about, and we were just saying that, yes, investment accounting is different than regular accounting. Investment, the attorneys, the skill set needed for the attorneys is different. It's just a different skill set. And so that was the other part of that, is to try and help compensate those professionals as well.
Questions for Patrick? Go ahead.
Mr. Chairman, I just want to make sure on the support staff, is that on the investment? Is it just those that you're talking about on the investment side, being the accountants, the attorneys? What about, is that solely it, or is there others in the office that would include?
Mr. Chairman, that includes all of the support staff that would assist the investment team. So that would include Matt, that would include me, that would include our attorneys, our paralegal, not unclaimed property, of course, not front desk. So.
And Mr. Chairman, Representative, the total amount on that was $312,000.
Okay, further questions? Okay. Any public comment? Any public comment? We'll close public comment. We have a motion on the bill.
Move the bill.
Moved and seconded. Okay, discussion on the bill. You want to walk us through it first?
Yep, sure thing, Mr. Chairman. 23 LSO 315, this draft, I think it's been well explained. So page 2, this is the statute concerning the treasurer's investment staff. Page 2, line 17 and 18 just changes the 25% to a maximum 35% for performance compensation for senior analysts and analysts. Page 2, line 21 begins the language regarding reimbursement of actual moving expenses. The employee must be moving to begin employment with the state treasurer's office and for the benefit of the state. Page 3, line 5 states that reimbursement cannot exceed the employee's actual moving expenses or $10,000, whichever is less. So it'd be capped at 10,000 or the actual expenses. Page 3, line 10 limits it to the investment staff. Page 3, line 15 notes that the reimbursement is only available to employees who are relocating to live and establish residency in Wyoming. The staff comment on the bottom of page 3 just notes the committee may wish to consider whether the COO or CEO that was from the last budget bill should be included in this reimbursement language. The top of page 4, and this would apply equally to the retirement system, that staff comment just notes whether the select committee may wish to consider language that would allow recouping those expenses if an employee does not work for a particular period of time, or if they're only employed for a short time with the state. Then page 5 repeats the language for the retirement system. So changes the 25 to 35%. The relocation language is virtually identical, except to refer to the retirement system. Then page 6 are just 2 placeholder appropriations. The staff comment on the bottom of 7 just notes that the committee would need to decide the amount of appropriation, if any, is necessary for this bill. With that, Mr. Chairman, I'll stand for questions.
Go ahead.
You know, looking at the report, I don't see in the bill, maybe it's someplace else, but I don't see anything as far as increasing the base salary. Does that need to be included in this bill, or?
Well, that was the question. And I think it would be, the appropriations would put it in the budget. Is that, I think that's my understanding, right?
Mr. Chairman, my understanding of the subcommittee's direction was just to prepare a bill with these 2 items. Whether the salaries could be placed in a bill in statute or the budget, I think that's a decision for the select committee. Certainly, placing them in statute would be for a longer period of time than just the period of a budget bill.
Yeah, actually, I thought they were going to be in the bill.
Mr. Chairman, I'm just going to make a motion. I don't know what the subcommittee had a recommendation on 20, 25, or 30, but I think we need to include those base salary increases in the bill.
Yeah, I would agree. But we did recommend the 35.
Mr. Chairman,
Go ahead.
I can barely hear you, and I can hardly hear Senator Hicks. I don't know if his mic is not on. Both could speak into the mic.
Yeah, so my recollection is the subcommittee, in fact, we recommended the 35, and we were intending to do that before we got the report from the respective agencies. And I don't know how we miscommunicated or how, but I think it ought to be statutory in terms of the base pays, so that at some point, there'll be different people who don't know what we did in the first place. So.
It makes much more sense to put it in statutes than it does for a 2-year term in a budget bill, because if for some reason, even if we missed, it would revert right back to the previous salary. Makes no sense.
Yeah. So, any further questions on that? Yeah.
So Mr. Chairman, I'll just make the amendment that we increased. So we have, on the memo, we've got 20, 25, and 30. So what was the recommendation of the subcommittee?
I don't have the memo in front of me. It was 35.
35 was for the differential between the analyst and the, so good. Somebody, we got something.
It's here somewhere. Yeah, I would just go from the memo.
Mr. Chairman?
Please.
But just kind of, so anyway, driving along at 80, I can't look at the memo, but my recollection was was there a math error in the analyst provision? It seemed to me that was 70 or 75,000, and then there had the comp pay, and it seemed to me the 2 of those, the calculation was incorrect of the total. I don't know if that affects whether it's a 25, 30, or 35 increase, but I just, you might want to take a quick look at that memo. Thank you.
So the 35% is what we were increasing the performance compensation, right? So that's what they can earn, that's paid out over a 3-year period. So that, right.
Yeah.
And so then the salary increases are there on table 1 at 20%, 25%, or 30%. And my recollection is our recommendation was to do the 20% from the working group. So that would be the middle chart,
Did you say 20 or 25?
20.
So 20 is lower end, Mr. Chairman. 20 was lower end, 25, 30.
Correct. That's my recollection. Who was else on that committee with me?
It was, Obermuller was on it too. He doesn't remember either.
Well, let's put that in the bill, and then we'll circulate the bill to the respective chairs, and then we'll kick it out. That's my recollection. The 70 would go to 84, and then up to 35%. We were going to reduce Patrick and Sam
So-
down to 150 though.
So, Mr. Chairman, just want to be clear. So the amendment would be increase in the bill, we'll add in statute, the base salaries for the 5 positions, increase those by 20% from the 2019 budget bill footnote, and do that for both state treasurer's office and retirement system.
Correct.
Okay. And then, Mr. Chairman, would you want to include the commensurate appropriation for those?
Well, the appropriation is it's funded out of the returns.
The base salaries are.
So we authorize is what we do.
Mr. Chairman, I think there would need to be budget authority for the increase.
Yeah, basically. So. Okay, any questions about that? Okay, as amended. Roll call. Sure.
I'm sorry, I just need one clarification, Mr. Chairman. So our senior investment officer, when we did the calculation and I prepared
Oh,
this.
that's right. This is kind of a goofy
I prepared it from 2017 because we were using 2017 inflation.
Because actually we were going down at 20%.
That's right.
Yeah.
So I just would like to clarify what is meant for, would it be a 20% increase from where that person is now, since everyone else is getting a 20% increase?
So how does that jive with the treasurer's office?
With the retirement system, their person is paid.
With the retirement system, I apologize.
Mr. Chairman, again, Dave Swindell, Executive Director of the Retirement System. I think the way we would recommend this be approached is a percentage increase, 20% or whatever, to the limits that are in the current 2019 budget note. Because in some cases, we're not quite at those levels.
And you're not paying the full amounts. Yeah.
Right. We have one analyst what we're paying the full amount for example. Well, one analyst is pretty junior and short of that. But still, this is about authority and maximum.
Right.
Yeah.
And in some cases, we would use that pretty quickly. And in other cases, maybe not so quickly. And that was probably the recommendation, maybe to go higher than 20%, because if it's 20% for some of these positions, we will use it pretty quickly. And a little more runway might be useful, but I think that for us, Don, that would be the metric, is go back to the existing limits in the budget footnote, increase those by 20%.
Agreed.
So I see.
So it doesn't really matter what the person are being paid now.
Right.
For the
So
most part,
I think that my recommendation to the committee was to go to 25%, except for the CIO. And the CIO would go to, would be at 300. Just because, I mean, when you proportion it out, that just made more sense to me. But, so that would be my suggestion as a starting gate for the current draft.
Mr. Chairman, in just so that I make sure, so on the retirement systems, they're saying that that percentage that we're talking about is from present budget footnote limits, not based on the 2017 differential.
So in order to do that, we need to have that in front of us to know exactly what we're doing. Do we have that? Can we call that up and,
I think I might.
because we were working
So,
on these
so,
numbers,
yeah,
the subcommittee was.
Mr. Chairman, this is, and I only have the treasurers pulled off, so I'll have to double check and make sure it's the same for the retirement system, but the maximum annual salary, $250,000 for the chief investment officer, $189 for a senior investment officer, $132 for investment, $93 for senior analyst, and $70 for analyst.
So that's what this has.
That's
So it's
what's in
not-
the,
it's not
excuse me,
different.
Mr. Chairman, that's what's in the memo. But when I did the 20% increase calculation, I did it from 2017 because we used 2017 inflation. So the actual amount for a 20% increase on the 189 in the current salary column is 226,800 rather than the 182,400. The 182,400 is based on the old salary of 152.
You don't want to cut their pay.
No.
That's a good point. No, so that number, on the 20% would be 226, right?
226,800.
226,800?
So I
Yes.
think we just want to use based on the memo, it'd be just 20% based on the current salary
Yes.
would be the motion.
Yes, please, Mr. Chairman.
And again, I think to bring in Director Swindell's, is it up to that amount?
Right. That's what it says.
So it's not saying it is, it says you can go up to that amount.
Right.
Says, is that,
Sam has to argue with me for every dollar.
Okay, everyone, so we're back to the 20%
20% on the current salary?
in the current salary.
Great. Thank you, Mr. Chairman.
Up to 20% on the current salary.
Okay, further discussion? Question?
Mr. Chairman, on 23 LSO 0315 as amended, Senator Driscoll.
Aye.
Senator Guru.
Aye.
Senator Hicks.
Aye.
Senator Kinski left a proxy vote.
Aye.
Oh, you are there, aren't you? Senator Nethercott.
Aye.
Thank you. Representative Hallinan.
Aye.
Representative Harshman. Representative Larson.
Aye.
Representative Overmueller. Representative Schwartz.
Aye.
Vice Chairman Nicholas.
Aye.
Chairman Perkins.
Aye.
12 aye.
Okay.
Thank you, Mr. Chairman. Special shout out to our representatives on the retirement system liaison, Representative Schwartz and Senator Nethercott. Senator Driscoll, we'll make you an honorary liaison. Thanks for the time at your ranch for the board this September. We had a nice evening event out at Senator Driscoll's ranch. It was very well done. Thank you very much. Thanks for your action on the bill.
And-
Okay.
Yeah, Mr. Chairman, would you like that to be a House bill or Senate file?
House is fine. They took the big one. We might insert the CEO in there. I was going to make an amendment to include those two guys. Relocation. Okay, Ian, what's next?
Mr. Chairman, the next topic is the active admission.
Okay, let's go to it.
Okay. All right, so Mr. Chairman, 23 LSO 251, working draft 0.4. This is a bill that Senator Hicks presented to the Select Committee back in September, and that the committee looked at, and the committee directed some changes in the resolution to propose amendments to the active admissions lease language and lease requirements. So this resolution would request that Congress introduce legislation to amend Wyoming's active admission to authorize the expenditure of investment earnings for this rather than just income. So it would strike references to interest and income, replace with earnings, and then amend lease provisions to give broader flexibility to the state, subject to leases of state school land securing the maximum long-term financial return. I won't go through the entire resolution once again, particularly the recitals, which begin on page 2. I would highlight 3, though, that are new recitals based on the committee's direction regarding the lease language. So page 2, line 15, just notes that the active admission authorized the state to lease granted school lands for mineral, grazing, agricultural, or other purposes, but those leases for agriculture and grazing purposes could not exceed 10 years. Then page 4, line 1 is the next new recital, and just notes that providing broader authority to the state for leasing granted school lands would allow the state to secure better long-term returns from leases. And then page 4, line 13 is another new recital stating that an amendment to the active admission to allow the state to lease granted school lands under state laws, subject to each lease securing the maximum long-term financial return, would allow the state to secure greater returns. Page 4, line 22, this is section 1. This is the ask of Congress and is the same as last time in September, except on page 5, line 5, asks Congress to amend provisions related to leases of granted school lands to maximize returns from those leases. Then page 5, section 2 provides kind of a template for Congress to follow in amending the active admission. And the changed language from the resolution considered in September is page 5, lines 21 to 25. So it strikes references to leases for mineral, grazing, agriculture, or other purposes. It would strike the 10-year lease maximum for ag and grazing leases, and just say that lands may be leased under this section so long as it secures the maximum financial return. Otherwise, the remainder of this resolution, as it was before, simply strikes references to interest and income and replaces those with earnings. With that, Mr. Chairman, I'd stand for questions.
So I do have a question. If we, on that line 24, if we say secure the maximum long-term financial return, depending on how that's interpreted, then if there are state leases out there that are agricultural, I wonder if we're making the net too tight. I mean, are we basically saying you got to go out and evaluate every single lease and maximize it, or you have to maximize it?
So, Mr. Chairman, I think the answer to that question would be to ask our neighbor, because I believe this came right out of Idaho's resolution to change their active admission, and that was done in 1998, and if they've had a problem with that language.
So Mr. Chairman, the language in here, and as was, the direction from September, that was the language that Idaho proposed for their active admission. That language did not end up in what Congress adopted. So the language Congress adopted was different. I don't believe it referenced a long-term financial return. I think the short answer to the question would be, it would be up to the state, given that, the leases may be under such laws as the legislature prescribes, it would be up to the legislature to decide what securing the long-term financial return would mean.
Mr. Chairman, actually, I don't know that it'll be so much the legislature, as, again, this is back to the fiduciary responsibility of the land board to make that decision as what would determine the maximum long-term return on investment, so.
Not only that, this is strictly financial too, the way this is crafted. Yeah. So I think we need to know what Congress actually passed in Idaho. Yes.
Yeah. Mr. Chairman, I wholeheartedly agree with you on that, because there's times when the land board will, if we're permissible by statute, will take into other considerations whether or not, whether it's just the highest lease amount. And that goes into the preferences that are already built into the statutes as far as, retaining the lease after the 10 years on that preference, just to meet the rate in other areas where there's preferences. And then we look at the whole community as far as whether or not that is going to negatively impact a producer to the point where they would go out of business and cause a financial drain on the whole community and actually decrease the revenues that are available to the state to fund education and so it's more of a holistic thing when it gets down to some of these things, because we don't want to have our hands tied so much that we're going to allow billionaires come in, lease up all of the land to a point where it's economically non-feasible for our base industries to be able to afford to continue. So, yeah, it's as much flexibility as you can put in the active admission. And I agree with you that we need to find out what Congress did pass and see whether or not that works for us. And I'd say if that'll work for us and doesn't tie our hands, is that we start at that point.
So really, instead of saying this section shall secure the maximum long-term financial return, it needs to say, as prescribed by the legislature, as determined for the best interest of the state.
Yeah, Mr. Chairman, here's the language in Idaho's bill. Land granted under this act for educational purposes may be leased in accordance with state law.
That's all it needs to say.
Yeah.
So I would make that amendment. Move in second. Further discussion? Move the bill. Yeah, I think it is.
Moved and seconded.
So it's moved by Senator Hicks, seconded by Representative Larson. So, question on the amendment. All those in favor say aye.
Aye.
Those opposed? That motion carries. Any noes? Okay, back to the bill. Anything
Question?
else on the bill? Go ahead.
Thanks, Mr. Chairman. So, Brian, we talked briefly about the Miners Hospital, and you referenced what Arizona had done. I don't know exactly how the Miners Hospital is addressed in the active admission. I haven't done my homework. But am I correct in thinking we might want to do the same language for them in terms of earnings versus interest at least?
Mr. Chairman, just my thoughts real quick on that is if we do that, we do it as a separate resolution. Same thing, but a separate, because there are probably different provisions within our active admissions. I don't know that.
Can I ask, let's say, can we ask Brian about this? Because he showed me the Arizona one, and it was all in one.
So, Mr. Chairman, Arizona did have an active admission amendment that addressed, their trust funds and their earnings. It also did include an amendment regarding their miners hospital endowment. Our language was not as, in the active admission was not as clear about the miners hospital. There is no reference to earnings. The only references, this is section 11 and section 12, just notes that the lands that were granted shall be held, appropriated, and disposed of exclusively for the purposes herein mentioned. So it's really, the language is really just unclear what the status of that is in light of the active admission.
I will leave this to the body that is serving in January. But I think, I really, just bear in mind, because we want to make sure we are addressing all the concerns.
Yeah, if we do it once, it'd be nice to cover everything, but. Okay, question on the bill as amended. Roll call. Fix this.
On 23 LSO 0251 as amended, Senator Driscoll.
Aye.
Senator Guru.
Aye.
Senator Hicks. Senator Kinski.
Aye.
Senator Nethercott.
Aye.
Representative Hallinan.
Aye.
Representative Harshman. Representative Larson.
Aye.
Representative Obermuller. Representative Schwartz.
Aye.
Vice Chairman Nicholas.
Aye.
Chairman Perkins.
Aye.
12 aye.
Mr. Chairman, House or Senate?
I think it's a Senate bill. We've got 25 minutes. What else do we want to do? Next, Brian. Ian, whatever.
Mr. Chairman, we're part of that agenda for statutory updates and reports from the Treasurer's Office.
Okay, come on up.
Hello again, Mr. Chairman and Committee. Don Williams, Deputy State Treasurer. We have a number of reports that are due to you on November 1st, and we generally just turn those in. And this is an opportunity for you all to ask us any questions if you have any. They are the balances in these accounts, the Hathaway and the Excellence in Higher Ed and Tomorrow Fund. We turn in a public purpose investments report to you, and we provide our spending policy modifications recommendations, and we provide our performance compensation report, which unfortunately is the, as you might recall, this report requirement to be due November 1st is prior to when we can actually provide the information and do the calculations for our performance compensation. So we end up reporting it to you to meet the statutory requirement, and then we update it later after our calculations have been performed. And this is due to us being able to get that year-end alternative investment information from our managers, who then give it to RBK to gyrate it, and then we have to perform the calculation. So it's just not possible by November 1st. But the payments do need to be made by the end of December, so we do get it done just as soon as we can, so that we end up updating that report. Any questions for me?
Go ahead.
So if you look on the third page of the report, and first one up is the Hathaway scholarship accounts. And you can see, Mr. Chairman, the pages aren't numbered, but it's 102 on the PDF. But so you can see the tip of $7 million into the corpus, 27 million left in the reserve account. And then you go to the next page, 103 on the PDF, and the amount of money left in the expenditure account on July 1st, zero. Okay, and so that's where this sweep has occurred from the expenditure to the reserve, and the reserve is over the 4.5%, so it tips into the corpus. And now in August, oh, there's no money in the expenditure account, we got to dip into the reserve account. And so you got this back and forth going. And it's a pretty simple fix. It's literally timing, because this investment income won't hit until October to fill up the expenditure account. So it's just back and forth. We could fix this, we have a bill draft, or we can just let it go and know that we got to continually educate our members that.
So the bill draft
Hathaway is
could just
not
make,
going broke.
the bill draft could just tip it in November or January.
You could delay the tip, absolutely delay the tip and keep the two accounts, or you just make one account. And it's not this back and forth. We've had this, it was an education committee bill last year, didn't make it. And it really should have came out of this committee, but it,
Well, Mr. Chairman, might as, now that we're talking about moving the reserve account into the total return fund, it might be appropriate to keep the two separate funds, keep that expenditure account, and then just change the tip date.
change the tip date. And I think like a November 1st, or what would you suggest? Seems like you get all the revenue and everything is kind of by October, all situated.
Mr. Chairman, we could do it October 1st. That's after the payments are due to the university and after the end of that first quarter.
And they pay, yeah.
So I would suggest that we just have the bill draft, make it a cap fin bill, and let's vote on it, and we'll make it effective, let's say October 15th, just to get some leeway. And just change the tip. That, everyone agreeable with that?
Okay.
Okay, why don't we take a roll call vote on the conceptual bill, because it's really simple.
Just to be clear then, so the conceptual bill is, the prior one, as he said, was actually consolidated accounts. I got rid of
This
the
one just
reserve
changes
account
the tip date.
to October 15th.
Correct.
Okay.
Yep. Okay, roll call, as amended. October 15th.
Roll call
Because we're
vote.
not going to meet again, so I think we need to take a vote on it.
Absolutely. Roll call vote on the conceptual bill. Senator Driscoll. Aye. Senator Guru.
Aye.
Senator Hicks. Senator Kinski.
Aye.
Senator Nethercutt.
Aye.
Representative Hallinan.
Aye.
Representative Harshman. Representative Larson.
Aye.
Representative Obermueller. Representative Schwartz.
Conceptual, aye.
Vice Chairman Nicholas.
Aye.
Chairman Perkins.
Excuse.
You have 11 aye, 1 excused.
That could be a House bill. It's a tough one. Anything else on your spending policy report?
Mr. Chairman, I think the treasurer would like to talk about that.
If you go to 902, and there's a recommendation there, and it's just not from me, but I asked the State Loan Investment Board to opine on it. And essentially, we keep everything the same, but we request that you consider a constitutional spending policies. And I guess that goes to the discussion that we had about ladders earlier and frogs and cookies. So we're asking for the.
Well, we can put that in the bill.
Yeah.
The
Asking
Constitution.
for the ladder to be taken away. And I think that in the long run, I think that it's worked good for New Mexico and a couple other states. I think it would give us a lot more consistency.
So my 2 cents on that is that I think that's a topic for the next CapFin group, not this one. I mean, that's a long, complicated issue. And anything that we draft is going to have, I mean, if when we fall into the 1980s, if that happens again, and interest rates are 14%, the idea of having a hard number just doesn't make any sense to me. But that's something we got to figure out.
Yeah.
So.
Yeah. The nice thing about it, if you have real good earnings, they're going to go tip back into the corpus, and you're going to increase your overall earnings on a steeper
growth
glide
curve,
path.
yeah.
Yeah.
I understand, yeah. Okay, well, we appreciate it, and I really do think that ought to be a major issue that CapFin tackles next year. Yeah. Right, yeah. Yep, I agree. Okay. Thank you, appreciate it. I think that clears the deck, does it not? Okay.
Mr. Chairman, we do have one more thing, and it's item 9-02. It's the draft of the committee's spending policy recommendation that goes to the legislature every year before it convenes. It's statutorily required. And so the document in your packet is, drafted. The intention is to have the committee discuss and guide staff on how you'd like to have this finalized, as well as it does include the flow charts that we usually see every year for the results of what happened for the fiscal year that's just concluded, fiscal year 22. I'd be happy to walk through those flow charts if you would like, however you would like to proceed, but yeah.
How is this different from the last one we did?
Mr. Chairman, yes, thank you for asking. This spending policy report as drafted, first of all, is addressed to the 66th Wyoming legislature and elected members of the 67th. So it's designed to go to both. The committee is not recommending any changes to the spending policy amounts, but then as drafted, this report goes on to describe the committee's work around 181 for adequate funding of the reserve accounts. And that could certainly be removed from the report or modified however the committee would like. Then on pages 2 and 3, it really is just an overview of how the spending policies have developed over the years. Then at the bottom of page 3, it's the results for fiscal year 22, which goes along with the flow charts in the appendices. And then on page 5, it's the reserve accounts and talking about the duration of the reserve accounts. And the table on the top of page 6 shows that they're estimated to have 6 years or more till exhaustion. And then the part at the bottom of page 6, again, is a part that was not there last year and is a little bit more inclusive than the report has to be. It's about the detail of the adequate funding of the reserve accounts that we've already talked about with those amounts summarized in table 3. And then at the very end, it just gives the status of the interim work and the 4 other bills that the committee is sponsoring. And there may be another one as well with this last one. And so that's really the report. The committee typically takes a vote to, direct staff on any changes they would like, and then takes a vote to adopt and give leeway to the chair and the vice chair to work with staff to finalize.
That was going to be my recommendation, is that we adopt in principle and allow the chair and vice chair, even if the chair, the other vice chair, is no longer in that position, he still has to do the work. So next week.
If you say so.
So are you?
Chairman, I move the report.
Is there a second?
Second.
Moved and seconded. Any further discussion?
Chairman, I think it's really good. I think it's another educational piece, so appreciate all your work on this. It'll be important for the rest of the body to be able to reference it, I think, so thank you.
So with that, all those in favor that this will be finalized through the chairs and we'll submit it. Basically, just, I need to read, I just sped read it last night in bed. I need to do that one more time, a little bit more thoroughly. So all those in favor say aye.
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 Those opposed? All right, that motion carries.
Thank you, Mr. Chairman.
All right. Anything else?
You got 10 minutes.
We got 11 minutes. Yeah. All right. Well, thanks, everybody. This is a fun committee, and we're doing fun things. It's It really is enjoyable. Been enjoyable working with everybody. Thanks, staff. Appreciate your work.